Welcome to Treasury Professional Mastery, where we begin our journey into the rigorous standards of the Certified Treasury Professional designation. In this opening module, we will outline the essential framework of the exam and establish the foundational mindset required for success. This course is an unofficial, independently produced educational guide and is not affiliated with, endorsed by, or connected to the Association for Financial Professionals, AFP. Additionally, this content is for informational and entertainment purposes only and does not constitute financial, legal, or tax advice. Always consult a qualified professional before making financial or legal decisions. Achieving the CTP designation is arguably the most significant milestone for anyone looking to distinguish themselves in the crowded field of corporate finance. This course is meticulously designed to bridge the gap between academic theory and the pragmatic, high-stakes decisions you face daily in the Treasury Department. By committing to this curriculum, you are not just studying for an exam, you are adopting a global standard of excellence that signals to employers your mastery of liquidity, risk, and capital management. We provide a structured environment that dissects the complexities of the Association for Financial Professionals syllabus into manageable, actionable modules. Our approach focuses on the logic behind Treasury management decisions, ensuring that you understand the why rather than just memorizing definitions. You will gain clarity on the examination structure, including the specific weightings assigned to each domain, which allows you to allocate your study time with surgical precision. We cover the full scope of professional ethics and standards of conduct, which serve as the bedrock for the certification. This module serves as your roadmap, orientation, and primary tool for navigating the intricate landscape of the Treasury management handbooks that define your testing future. The value of this certification extends far beyond the badge itself, as it places you within an elite group of practitioners recognized for their ability to navigate global Treasury challenges. We will examine the core competencies necessary to pass the exam, from the technical nuances of cash positioning to the broader strategies of corporate risk management. You will learn how to approach your daily career responsibilities through the lens of a certified professional, integrating best practices into your operational workflow. The primary objective here is to equip you with the mental models necessary to simplify complex scenarios, making the exam day feel like a natural extension of your professional expertise. I look forward to guiding you through these concepts in our upcoming sessions. Welcome back. In this chapter, we will explore the essential roles within a Treasury department and the complex global regulatory environment that dictates how those functions operate. The organizational structure of a Treasury department typically shifts based on a company's operational scale, geographic footprint, and overall risk appetite. Large multinational corporations often lean toward a centralized model, where a single corporate treasury team manages global liquidity, risk, and banking relationships from a headquarters location. This centralization allows for the optimization of cash across subsidiaries, ensuring that excess funds are deployed efficiently rather than languishing in isolated local accounts. Conversely, a decentralized model might delegate liquidity management to regional offices, which can be advantageous in markets with significant legal or currency restrictions, preventing effective cross-border cash movement. A fiscally responsible Treasury organization must balance these structural choices with the clear oversight requirements of the Board of Directors. The Board establishes the guiding principles for the Treasury's mandate, ensuring that liquidity and risk management strategies remain aligned with the corporate strategy and shareholder interests. Entering the realm of global regulations requires an appreciation for how interconnected and stringent the modern financial landscape has become. We have moved past the era where Treasury functions were solely focused on cash flow. Today, Treasury professionals are essentially compliance managers operating within high-stakes frameworks. Consider the post-2008 regulatory environment, dominated by mandates like the Dodd-Frank Act and the Basel III Accord, which fundamentally altered capital requirements and liquidation buffers for financial institutions and, by extension, the corporations that use them. The Financial Stability Oversight Council plays a critical role here by monitoring for systemic risks that could threaten the broader economy, often resulting in increased reporting burdens for large Treasury departments. These regulations are not theoretical. They manifest in the cost of debt, the types of collateral accepted by banks, and the level of liquidity maintained on a balance sheet. Navigating these requirements effectively is what separates a proficient Treasury team from one that exposes the organization to massive regulatory fines or reputational damage. Compliance and security protocols represent the frontline defense for Treasury operations, specifically regarding Know Your Customer or KYC standards in anti-money laundering protocols. When you interact with foreign subsidiaries or initiate cross-border payments, you are effectively verifying the identity and risk profile of your counterparties to satisfy global regulatory expectations. These operational demands are further compounded by strict adherence to the Office of Foreign Assets Control, or OFAC, sanctions lists, which mandate that organizations avoid conducting business with specific entities or nations deemed hostile or high risk. Simultaneously, the Patriot Act imposed additional rigor on financial transactions, forcing Treasury units to implement robust vetting processes for all incoming and outgoing funds. These internal controls are not merely suggestions but requirements that must be audited and verified, often falling under the broader governance umbrellas like the Sarbanes-Oxley Act. Compliance is now a core component of daily operations, ensuring that the movement of cash and securities follows rigid, documented, and auditable paths that protect the enterprise from financial crime. Ultimately, a well-functioning Treasury Department is defined by how it harmonizes these external regulatory requirements with internal control frameworks. Internal controls are designed to mitigate the risk of fraud, error, or mismanagement of corporate assets, and they must be scaled to the specific risk appetite established by executive leadership. Corporate governance best practices demand that there be a clear separation of duties where, for instance, the individual initiating a payment is never the same individual who authorizes it. This principle of dual control is the bedrock of secure treasury management. Furthermore, the legal environment for operations is increasingly international in scope, forcing treasurers to understand how foreign jurisdictional laws impact local cash repatriation or tax liabilities. As you analyze your own organizational structure, think about how these controls act as both a hurdle and a protective layer, ensuring that the company maintains its functional integrity while scaling globally. Mastering these regulatory intersections is what allows a treasury professional to function as a strategic asset rather than an administrative cost center. See you in the next lecture. Welcome back. In this chapter, we explore the mechanical foundations of the global financial system, specifically focusing on how value moves between entities through regulated payment systems. To understand the payment lifecycle, we must distinguish between clearing and settlement, two processes often conflated but technically distinct. Clearing involves the reconciliation and transmission of payment information between the payer's bank and the payee's bank, essentially confirming the details of the obligation. Settlement, conversely, is the finality of the transaction where the actual transfer of value occurs, extinguishing the debt. In a gross settlement system, every individual transaction is settled on an instruction-by-instruction basis, which minimizes counterparty risk but requires significant liquidity. Conversely, net settlement systems aggregate obligations over a period and transfer only the net difference, which optimizes liquidity but introduces settlement risk should a participant fail before finality. Real-time gross settlement systems, or RTGS, represents the gold standard for high-value payments where finality is required immediately. Within the United States, Fedwire is the primary RTGS network, where transactions are processed individually and settled against reserve accounts held at the Federal Reserve. Because these are irrevocable and immediate, Fedwire is essential for critical enterprise tasks such as interbank settlements and large-scale corporate disbursements. In contrast, CHIPS, the clearinghouse interpayment system, utilizes a multilateral netting process for high-value international and domestic payments. While also providing substantial throughput for financial institutions, CHIPS manages liquidity through a centralized queue that minimizes the capital institutions must hold to facilitate the daily volume of traffic. The messaging architecture that bridges these systems relies heavily on the SWIFT network, which provides a standardized platform for secure financial communications. Each participant in this ecosystem is identified by a Business Identifier Code, or BIC, which acts as a unique address for an institution, ensuring that instructions are routed to the correct destination. These messages follow rigorous international standards, such as ISO 20022, which facilitates machine-readable data across borders. As international payments move across multiple jurisdictions, They often require correspondent banking relationships where nostro and vostro accounts are used to manage cross-border liquidity. This complexity creates challenges in tracking funds, as transparency can diminish whenever the transaction hops through intermediary institutions. The automated clearinghouse, known as ACH, serves a different purpose, specializing in high-volume, low-value batch processing rather than the immediate finality of wire networks. Operating under regulations and rules dictated by the NACHA organization, the ACH system allows for both credit and debit entries to be processed in files rather than individually. Organizations utilize this for payroll, tax payments, and consumer billing, where the velocity of a wire transfer is unnecessary and the associated transaction fees would be prohibitive. Because batch processing involves a delay between the initiation and the settlement date, treasurers must account for this float when managing cash positions. Understanding these timelines is essential for maintaining liquidity buffers without tying up excessive working capital in pending status. Check processing has evolved significantly, shifting from the physical movement of paper to image-based exchange under the Check Clearing for the 21st Century Act. The Image Replacement Document, or IRD, serves as a legal equivalent to the original paper check, allowing banks to settle accounts based on digital photographic representations of the instruments. Remote deposit capture further enhances this efficiency by allowing remote branches or corporate treasury departments to scan checks and transmit data directly to the bank. This reduction in the physical transportation of paper documents has substantially decreased the cost and time delays associated with traditional check float. However, Treasury professionals must remain vigilant, as the digitization of check processing brings its own unique set of security risks regarding fraud and data integrity. Modern financial infrastructure is characterized by a drive toward greater efficiency and reduced settlement overhead through technological integration. As we look at these systems, the convergence of messaging standards and real-time connectivity continues to blur the lines between batch and gross settlement. The primary goal for any treasury function is to bridge these disparate systems into a cohesive, visible cash management strategy that honors the nuances of each network. By understanding the underlying risks, such as settlement lag or cross-border latency, you are better equipped to design payment processes that optimize corporate liquidity. The structural integrity of these platforms dictates the reliability of your organization's entire cash management ecosystem. I look forward to our next discussion as we continue investigating the Treasury landscape. Welcome back. Today, we turn our focus to the mechanics of card-based transactions and the evolution of financial payment technology that is redefining how Treasury departments operate. When we examine the landscape of corporate payments, we must begin with the standard infrastructure of credit, debit, and purchasing cards. A purchasing card, or P card, is essentially a corporate charge card that allows employees to procure goods and services without the friction of a traditional purchase order process. From a Treasury perspective, the efficacy of a P card program relies entirely on the controls established during implementation. You need to consider parameters such as individual spending limits, merchant category code blocks, and automated reconciliation workflows to prevent leakage. The primary benefit is not just administrative convenience, but the reduction of the cost per transaction when compared to manual accounts payable processing. By shifting low-value expenditures to these cards, the Treasury team can focus their limited human capital on more strategic financial tasks. However, these programs are only as robust as the audit trail they generate for downstream accounting systems. The complexity of the merchant acquiring process is often abstracted away, but it is vital to understand the participants involved in every swipe or digital transaction. When a card is used, the merchant acquirer acts as the bridge between the merchant and the issuing bank, ensuring that the payment data flows securely through the network. A significant portion of the cost associated with this process is found in interchange fees, which are the per-transaction fees paid by the merchant's bank to the card-issuing bank. These fees are not arbitrary. They are assessed based on a schedule determined by card networks to cover the risks associated with transaction processing and fraud. To protect this sensitive data, we observe the widespread adoption of encryption and tokenization. Encryption obscures the data during transmission, while tokenization replaces sensitive primary account numbers with non-sensitive equivalents, effectively neutralizing the value of the data if a breach occurs. Moving beyond traditional infrastructure, we are seeing a significant transition toward emerging payment trends that prioritize speed and data integration. Mobile wallets and contactless payments have drastically reduced the physical friction point at the point of sale, though their integration into corporate treasury remains a work in progress. More importantly, we are seeing the rise of API banking, which allows for deeper integration between corporate enterprise resource planning software and banking systems. This movement towards instant settlement infrastructure is largely driven by the evolution of real-time payments networks, which are becoming the global standard for liquidity management. As these systems mature, Treasury professionals are also evaluating the implications of blockchain, distributed ledger technology, and the nascent development of central bank digital currencies. These developments promise to minimize settlement latency, though they introduce new variables regarding liquidity management that you must prepare to navigate. Consider the impact these emerging technologies have on the utility of treasury functions, particularly regarding cryptocurrency and central bank digital currencies. While cryptocurrencies remain volatile, their underlying ledger technology provides a template for instantaneous, irreversible settlement that could eventually replace slower legacy clearinghouses. The implementation of a central bank digital currency, or CBDC, represents a potential paradigm shift in cash forecasting because it allows for direct visibility into liquidity positions. For a Treasury department, this means that the traditional cycle of waiting for overnight clearing might fade, forcing a move toward continuous cash positioning. We must remain critical of how these tools integrate into existing risk frameworks, specifically regarding compliance with anti-money laundering and know your customer regulations. The future payment roadmap will certainly favor systems that offer the greatest transparency and the lowest cost of transaction processing. See you in our next session. Welcome to our exploration of working capital management fundamentals, where we will examine the mechanics of liquidity and operational efficiency. In this chapter, we will dissect the metrics that define how effectively a firm utilizes its short-term assets and liabilities to drive value. Working capital is effectively the lifeblood of any organization, representing the difference between current assets and current liabilities. At its core, it measures the net liquid assets available to support day-to-day operations and provides an immediate snapshot of financial health. When we analyze the operating cycle, we're looking at the average time required to acquire inventory, sell it to customers, and collect the resulting receivables. This cycle is fundamentally linked to the cash conversion cycle, which measures the number of days capital is tied up in the business during these processes. By calculating days inventory outstanding, days sales outstanding, and days payable outstanding, we can isolate where funds are being trapped. If a company takes too long to collect on sales or holds excess inventory, it essentially increases its need for external financing. Every day we shorten in this cycle creates an opportunity to redeploy that cash into more productive investments. Liquidity ratios provide the necessary rigor to evaluate whether a firm can meet its short-term obligations without distress. The current ratio remains the most common metric, calculated by dividing current assets by current liabilities, yet it often masks potential inefficiencies. By moving to the quick ratio, or the acid test, we exclude inventory to see if the firm can cover liabilities using only its most liquid assets like cash and receivables. This filtering process is crucial when assessing firms with specialized or slow-moving inventory. We then extend this analysis to efficiency metrics like the working capital turnover ratio, which tells us how many dollars of sales are generated for every dollar of invested working capital. High turnover usually signals a lean operation, but it can also indicate a risky lack of a safety buffer. Balancing these efficiency ratios against standard industry benchmarks allows a treasurer to identify whether their liquidity profile is optimal or merely an outlier. External and internal factors heavily influence how a company structures its approach toward working capital investment policies. Industry-specific cycles dictate the baseline. For instance, a retailer might have drastically different needs compared to a utility provider due to inherent seasonality. When we look at supply chain finance, we are essentially leveraging the company's creditworthiness to provide liquidity to vendors, which can optimize the balance between payable outstanding and cost of goods sold. Management must then choose between aggressive and conservative policies based on their risk appetite. An aggressive strategy minimizes the investment in current assets to boost profitability, but increases the risk of a liquidity shortfall. Conversely, a conservative approach carries higher levels of cash and inventory, which provides a comfortable cushion but sacrifices potential returns on that idle capital. Ultimately, the goal is to determine the point where the marginal cost of carrying working capital is equal to the benefit of the liquidity provided. See you in the next lecture. Welcome to the chapter on receivables and payables management, where we explore the strategies necessary to optimize your organization's cash conversion cycle. By mastering these components, you will gain the technical expertise required to manage liquidity with precision and enhance overall corporate value. Effective management of accounts receivable begins with a robust credit policy that balances the desire for sales growth with the reality of default risk. When you establish credit terms, you are essentially providing an interest-free loan to your customers, which directly impacts your company's working capital position. Conducting a thorough credit analysis involves evaluating the 5 C's of credit, which include character, capacity, capital, collateral, and conditions, to determine the likelihood of timely payment. Once credit is extended, your collection procedures must be standardized to minimize days sales outstanding, ensuring that receivables turn into cash as quickly as possible. If a customer fails to meet the agreed terms, having a clear escalation path for dispute management is critical to maintaining both cash flow and valid vendor-client relationships. By integrating these practices, a treasury professional transforms the receivables process from a simple accounting function into a strategic tool for liquidity management. To accelerate the transition from receivables to available cash, Treasury departments frequently utilize specialized collection mechanisms such as lockbox systems. A wholesale lockbox is typically designed for high-dollar, low-volume business-to-business transactions, while a retail lockbox serves environments with high-volume, low-dollar consumer payments. The core objective is to decrease the float, the time between when a payment is sent and when the funds are collected, by redirecting mail to a bank-controlled site near the payer. In the modern treasury environment, we increasingly rely on electronic receivables and remote deposit capture to bypass physical paper processing entirely. Remote deposit capture allows staff to scan checks on site and transmit the images to the bank, which effectively achieves same-day deposit status. When payments finally arrive, the cash application process must reconcile these inflows with outstanding invoices, a task that has become increasingly automated to reduce human error and improve data accuracy. On the flip side, accounts payable optimization is a discipline of managing payment timing to serve the organization's broader financial interests. Making a decision on when to settle an obligation requires reconciling the cost of early payment, often through discounts, against the cost of short-term capital. For instance, a discount analysis might reveal that terms of 2% net 10 offer an annualized return that far exceeds the company's cost of capital, making early payment a rational strategic move. Conversely, if holding cash allows the company to fund operations without tapping into a line of credit, delaying payment until the due date becomes the optimal path. Electronic invoice presentment and payment systems further streamline this by digitizing the entire procure-to-pay workflow, allowing for better visibility and auditability. These systems allow Treasury staff to standardize vendor payments and capture data that can be used for sophisticated cash flow forecasting. Managing outbound funds also brings the critical responsibility of maintaining rigorous payment security measures to prevent fraud in disbursement processes. As organizations shift toward commercial cards and supply chain finance programs, the attack surface for bad actors grows, requiring robust internal controls and verification steps at every stage of the payment chain. Supply chain finance, or reverse factoring, allows a company to leverage its own credit rating to provide suppliers with early payment, often through a third-party financier. This strengthens the vendor relationship while allowing the buying firm to maintain its preferred payment terms. Furthermore, techniques such as dynamic discounting allow for variable payment dates that adjust based on the supplier's immediate need for liquidity. Throughout all these operations, the primary mandate remains the mitigation of risk, ensuring that every dollar paid out is authorized, accurate, and directed to the correct recipient. I will catch you in the next lecture. Welcome back to our journey through the essential functions of corporate treasury management. Today, we focus on how organizations maintain visibility over their liquidity through cash positioning and forecasting. Cash positioning is the foundational daily process of determining the firm's net cash balance across all bank accounts and legal entities. Treasury professionals begin each morning by reconciling the anticipated versus actual end-of-day balances from the previous period. This involves monitoring bank balances to ensure they meet target balance requirements defined by bank agreements. If an account has a surplus, Treasury may initiate a sweep toward a central account, whereas a deficit requires funding from the parent company or a credit line. The primary goal is to ensure that operating accounts have sufficient liquidity to cover today's obligations while minimizing idle cash balances that yield no return. Organizations often utilize zero balance accounts or ZBA structures to automate this internal liquidity movement. Under a ZBA arrangement, disbursement accounts are automatically funded to exact requirements daily, effectively concentrating excess cash into a single master account at the close of every business day. Effective cash concentration is a strategic requirement for global entities, as it allows for the centralization of liquidity, reducing bank charges and interest costs. Physical pooling involves the actual movement of funds from subsidiary accounts into a header account, which simplifies the process of manual positioning. Conversely, notional pooling maintains separate account balances legally, but aggregates them for interest computation purposes, allowing the firm to offset interest expense against interest income. Beyond day-to-day positioning, liquidity management requires an accurate view of future cash movements through structured forecasting. Forecasting rationales vary based on the planning horizon, with short-term models focusing on operational liquidity and long-term models supporting capital allocation or expansion strategies. The time horizon for a short-term forecast might be a rolling 13-week period, which aligns with typical cash management and revolving credit maturity cycles. When we look at methodologies for these forecasts, the receipts and disbursements method stands out as the most common approach. This method involves mapping out individual expected cash inflows and outflows chronologically, providing a granular view of transactional liquidity. Alternatively, the percentage of sales method is often employed for long-term planning where cash flow is presumed to correlate strongly with revenue growth. Financial analysts also utilize statistical techniques like moving averages to smooth out seasonal volatility and identify underlying trends in historical data. More advanced Treasury desks leverage regression analysis to model complex relationships between external economic variables and internal cash flow outcomes. These statistical approaches help remove subjectivity, although they must be balanced against the qualitative insights provided by regional Treasury heads. Choosing the right model depends on the organization's capability to extract high-quality data from internal ERP systems and the predictability of the business cycle. Once a forecast is generated, the work shifts to measuring its efficacy through rigorous accuracy metrics. Treasury must perform variance analysis to compare the forecasted figures against the realized actuals at the end of every period. Identifying the root cause of large variances is a necessary step to refine the forecasting process, as it distinguishes between timing differences and permanent changes in business volume. For instance, a persistent negative variance might indicate that customers are paying slower than current historical data suggests, requiring an adjustment to the model's assumptions. Continuous improvement is achieved through an iterative forecasting process, where feedback loops update the inputs for future iterations. By integrating data directly from enterprise resource planning systems, Treasury can automate the polling of ledger data and reduce the risk of manual processing errors. This integration is essential for improving predictive capabilities, especially in volatile market environments where rapid data availability determines the effectiveness of investment or funding decisions. I look forward to discussing how these liquidity models influence our broader financial strategy in our next meeting. Welcome back. In this chapter, we will master the fundamental relationship between financial accounting standards and the practical realities of corporate treasury reporting. Financial accounting serves as the objective language of business, providing a standardized framework that treasury professionals must navigate daily. At its core, the income statement outlines the company's profitability by detailing revenues, cost of goods sold, operating expenses, and tax implications, which ultimately distill down to net income. This statement is essential for assessing operational performance over a specific period, yet it often hides the reality of cash movement. To bridge this gap, the balance sheet acts as a snapshot of financial health, displaying assets, liabilities, and equity at a singular point in time. Treasury professionals often focus heavily on current assets and liabilities, as these balance sheet line items provide the most direct insight into liquidity. Understanding how specific accounting principles, such as the matching principle or revenue recognition, influence these figures is the difference between a superficial reading of a statement and a deep analytical assessment. When we analyze financial statements through the lens of treasury management, our primary concern is often the cash flow statement. This document resolves the timing differences inherent in accrual accounting, which is the foundational basis for both GAAP and IFRS. The direct method to report cash flows from operating activities is intuitive, as it lists actual cash receipts and payments, providing a clear map of money entering and exiting the organization. However, the indirect method is far more common, as it adjusts net income for non-cash items like depreciation and changes in working capital accounts. Analysts must understand the transition from net income to cash flow, because an entity can be profitable on the income statement while simultaneously experiencing a terminal liquidity crisis. This distinction is vital when performing ratio analysis, which allows us to convert raw data into actionable insights about liquidity, leverage, and profitability. Liquidity and leverage ratios are the guardrails of Treasury strategy, providing a quantitative measure of whether an organization can meet its immediate and long-term obligations. Liquidity ratios focus on the short term, with the current ratio and the quick ratio serving as the primary indicators of a firm's ability to cover current liabilities with liquid assets. Conversely, leverage ratios examine the reliance on debt financing, where the debt-to-equity ratio and interest coverage ratios illustrate the sustainability of a firm's capital structure. Beyond these, management of assets is reflected in turnover ratios, which signal the efficiency of the cash conversion cycle and working capital usage. We also frequently look at EBITDA, which serves as a proxy for operational cash flow, though it must be approached with caution as it excludes critical non-cash adjustments and interest expenses. Understanding these metrics enables the treasurer to communicate the firm's creditworthiness to lenders and stakeholders with precision. As we move toward more complex financial structures, it is critical to recognize the accounting treatment of off-balance sheet financing and specific lease arrangements. Recent updates to reporting standards have largely eliminated the ability to maintain operating leases off-balance sheet, requiring most leases to be capitalized as assets and liabilities. This change fundamentally expanded the leverage profiles of many balance sheets and shifted the metrics stakeholders use for performance evaluation. Beyond leasing, the Treasury Department must ensure that the accounting for Treasury instruments, such as derivatives used for hedging, remains compliant. Mark-to-market accounting requires the revaluation of these instruments at current market prices, which can introduce significant volatility into the income statement. To mitigate this, hedge accounting allows for a more synchronized reporting of the derivative and the underlying exposure, provided the effectiveness of the hedge is documented and audited regularly. See you in the next installment. Welcome to the chapter on technology and relationship management, where we integrate the essential digital infrastructure of modern treasury with the art of managing institutional banking partnerships. We will navigate the complexities of treasury management systems, API connectivity, and the vital frameworks required to protect your organization from escalating cyber threats. Treasury management systems, or TMS, act as the central nervous system for today's Treasury Department, automating manual processes that were once prone to spreadsheet errors. Selecting the right platform requires a rigorous assessment of your specific workflows, as a system that is excellent for a multinational entity might be overly burdensome for a smaller, localized operation. When evaluating these systems, you must consider whether to integrate them with your existing enterprise resource planning software through native connectors or more flexible API architectures. APIs, or application programming interfaces, have fundamentally shifted how Treasury functions by enabling real-time data flow between the internal ERP and external banking environments. This shift allows for instantaneous cash positioning, which is critical when timing high-value disbursements or managing cross-border liquidity. Furthermore, the dashboard and reporting capabilities within these systems are not merely aesthetic. They provide the data visualization necessary for leadership to make informed decisions based on live financial insights. A well-implemented TMS reduces operational friction, ensuring that your data remains accurate, audit-ready, and accessible whenever a liquidity event demands a rapid response from your team. As we move toward higher levels of connectivity, The importance of cybersecurity protocols cannot be overstated, particularly regarding the sophisticated nature of contemporary fraud. Business email compromise, commonly referred to as BEC, exploits the human element of your workflow by masquerading as trusted communication to initiate unauthorized transfers. Phishing and ransomware remain persistent threats, requiring Treasury teams to implement strict control frameworks that mandate dual authorization for all outgoing payments regardless of the dollar amount. These controls should extend beyond internal procedures to include technical safeguards like multi-factor authentication and encrypted communication channels with your banking partners. You need to view your TMS security not as a static configuration, but as a dynamic, evolving defensive posture that adapts to the latest industry threat intelligence. By layering these technical controls within your operational policy, you create a robust defense that protects company assets from the increasingly clever social engineering tactics used by external actors. Security is an ongoing commitment to hygiene, regular audits, and the rigorous enforcement of policies that prevent any single point of failure within your payment cycles. Bank relationship management is the human counterpart to your technological infrastructure, shifting from simple transactional processing to a strategic partnership focused on mutual value creation. When initiating a request for proposal, or RFP, you are not just shopping for interest rates, but evaluating the service selection criteria that align with your firm's operational footprint. You should develop custom evaluation matrices that weight factors like local market presence, technological support, and the ability of the bank to integrate with your specific ERP environment. Once a partnership is established, the complexity shifts to maintaining transparency in the billing structure through the analysis of account analysis statements. You must become adept at interpreting AFP service codes, which provide the standardized language needed to reconcile what the bank billed versus what you actually consumed. This exercise in bank fee analysis is essential for identifying inefficiencies, such as paying for features that your daily operations no longer utilize. By managing these costs with the same rigor you apply to forecasting, you effectively minimize the drag of banking fees on your overall working capital. Pricing negotiations are rarely about a single static fee, as they involve a complex interplay between cash balances and service consumption. Banks often look at your earnings credit rate, or ECR, which is the interest rate applied to your collected balances to offset monthly service costs. You must determine whether it is more cost-effective to utilize compensating balances to pay for services through your ECR or to pay cash fees directly from your operating budget. This calculation requires an understanding of your organization's internal cost of capital and the current interest rate environment, as these variables shift the economic benefit of each strategy. A sophisticated treasury professional uses a scorecard to track these banking relationships over time, ensuring that the service quality meets the defined service level agreements. If your scorecard reveals that a partner bank is failing to deliver on promised integration speeds or reporting functionality, you gain the leverage necessary to renegotiate either the pricing or the level of service. Strategic relationship management is ultimately about aligning the bank's capabilities with your organizational goals, transforming the bank from a mere service provider into a vital extension of your treasury operations. I will see you in the next lecture. Welcome back. In this chapter, we will explore the mechanisms of capital structure, the cost of capital, and the rigorous decision-making criteria required for corporate investment. The fundamental objective of any corporate finance strategy is to determine the optimal mix of debt and equity that maximizes shareholder value. The Modigliani-Miller theorems provide the bedrock for this analysis, initially suggesting that in a frictionless market, the value of a firm is independent of its capital structure. However, once we introduce real-world variables such as corporate taxes and financial distress costs, the relevance of debt becomes apparent. Debt introduces a tax shield because interest payments are typically tax deductible, effectively lowering the cost of borrowed capital compared to equity. Yet, this benefit is constrained by the rising probability of bankruptcy as leverage increases. Companies must navigate this trade-off carefully, balancing the tax advantages of debt against the potential costs of increased financial risk. Financial executives often evaluate leasing against buying as a specific application of these capital structure considerations. The decision to lease often shifts the capital requirement profile and alters the balance sheet impact compared to direct debt finance purchase. Ultimately, the quest for an optimal capital structure is about aligning long-term financial flexibility with the firm's specific operational constraints. To assess the efficacy of these structural choices, we must accurately calculate the cost of our funding sources. The cost of debt is relatively straightforward to calculate on an after-tax basis by adjusting the nominal interest rate by 1 minus the marginal corporate tax rate. In contrast, estimating the cost of equity is more nuanced because it represents the return required by shareholders to compensate for the systematic risk they assume. We frequently utilize the capital asset pricing model, or CAPM, which determines the expected return based on the risk-free rate, the equity market risk premium, and the stock's sensitivity to market movements, known as beta. Alternatively, the dividend discount model can estimate the cost of equity by capitalizing current and future expected dividend payments, though this approach assumes a degree of stability in dividend policy that may not exist for all firms. When these components are combined, we arrive at the weighted average cost of capital, or WACC. This metric serves as the hurdle rate for any new investment, representing the minimum return a company must earn on its existing asset base to satisfy its creditors and shareholders. Calculating WACC requires careful attention to how we weight each source of capital, specifically whether to use book value or market value. While book values are readily accessible in financial reports, market values provide a more accurate representation of the cost of raising new funds under current economic conditions. Furthermore, companies should focus on the marginal cost of capital, which is the cost of the next dollar of new financing, rather than the historical weighted average of existing debt and equity. Once the cost of capital is established, the focus shifts to investment decision criteria, such as net present value and the internal rate of return. Net present value remains the gold standard because it directly measures the increase in absolute dollar value, whereas the internal rate of return identifies the discount rate where the net present value is zero. The payback period is useful for liquidity assessment but often ignores the time value of money and terminal cash flows. In practice, capital rationing may impose limits on which projects receive funding, necessitating a disciplined, data-driven approach to ensure that capital is allocated only to initiatives that enhance long-term corporate value. See you in the next lecture. Welcome back. We are now turning our attention to the mechanisms companies use to raise capital through debt and equity instruments. In this chapter, we will strip away the complexity surrounding financing decisions to look at the practical reality of corporate funding. When a firm chooses short-term financing, it often looks toward the money market rather than traditional institutional loans. Commercial paper is perhaps the most prominent example of this, as it consists of unsecured, short-term promissory notes issued by corporations typically to meet immediate liquidity needs. Because these notes are unsecured, only firms with high credit ratings can issue them effectively at a reasonable cost. Alternatively, firms may establish bank lines of credit, which provide a pre-negotiated amount of liquidity that can be drawn down as required. A letter of credit, or LOC, functions as a guarantee from a financial institution that a beneficiary will receive payment, effectively substituting the bank's creditworthiness for that of the purchaser. Revolving credit facilities take this a step further by providing a formal commitment from a bank to lend up to a specific limit over an extended period, allowing the corporate treasurer to manage cash flow volatility with greater predictability. Long-term debt issuance is a more structural commitment, involving deeper engagement with capital markets through bonds or private placements. A public bond issuance requires significant regulatory compliance and disclosure, providing access to a broad base of institutional investors. Conversely, a private placement involves selling securities directly to a select group of investors, which can offer lower issuance costs and speed, but often results in a higher cost of capital due to reduced liquidity. Within these debt structures, the hierarchy of claims is enforced through seniority. Senior debt occupies the primary position in the capital structure, ensuring priority of payment in the event of liquidation, while subordinated debt ranks below senior claims. To protect their interests, lenders impose covenants on these agreements. Positive covenants dictate that a borrower must perform certain actions, such as maintaining minimum insurance levels, while negative and restrictive covenants forbid specific activities, such as excessive dividend payments or incurring further debt without consent. Equity financing fundamentally changes the ownership structure of the firm, representing a permanent claim on assets and earnings. Common stock grants voting rights and a residual claim on dividends, whereas preferred stock usually holds no voting rights but offers a fixed dividend preference over common shareholders. The process of transitioning from a private firm to a public one entails an initial public offering, or IPO, which is a rigorous, high-stakes event involving underwriters, regulatory audits, and significant market signaling. Following an IPO, a firm may return to the primary market through a seasoned equity offering, or SEO, to raise additional capital by issuing more shares. For private companies, venture capital and private equity serve as critical alternatives. These sources of funding provide not only capital, but often strategic guidance to early-stage or distressed companies, albeit at the cost of surrendering varying degrees of control and ownership to external investors. The decision to return value to shareholders through repurchase programs or dividend policies reflects a firm's long-term financial philosophy. A share repurchase program allows a company to buy back its own stock from the open market, which effectively consolidates ownership and can signal to the market that the company perceives its shares as undervalued. Dividend policies are categorized by their underlying rationale, ranging from stable dividends, which provide consistent payouts, to residual policies, where dividends are only paid out after all capital expenditure requirements are met. The constant payout ratio approach maintains a fixed percentage of earnings distributed to shareholders regardless of volatility. These decisions are heavily influenced by signaling theory, which suggests that dividend announcements convey information to the market regarding the firm's future prospects. Finally, tax clientele effects suggest that investors gravitate toward companies whose dividend policies align with their specific tax brackets, illustrating that Treasury decisions must account for the diverse preferences of the firm's investor base. See you in the next lecture. Welcome to our study of investment portfolios as they pertain to the corporate treasury function. In this chapter, we will master the mechanics of balancing safety, liquidity, and yield to ensure organizational stability and growth. When we construct an investment portfolio within a corporate treasury context, our primary objective is rarely to generate maximum returns, but rather to preserve the principal while ensuring immediate access to cash. Understanding the hierarchy of safety, liquidity, and yield is fundamental to how we frame our investment policy statement. The investment policy statement serves as the governing document that outlines permissible instruments, credit risk tolerance, and maturity constraints. By establishing these boundaries explicitly, the Treasury Department provides a defensible framework for the board and stakeholders, ensuring that the company's surplus funds are not unnecessarily exposed to volatile markets. Whether we deal with commercial paper, treasury bills, or money market funds, our decisions must always align with the liquidity needs of the operating cycle. Rigorous credit risk analysis is the cornerstone of this process, preventing us from chasing incrementally higher yields that come with unacceptable default risks. Diversification is the primary defense against systemic credit risk, requiring us to set limits on how much we invest in specific issuers or asset classes. We achieve this by applying maturity constraints that force us to match the duration of our investments with the anticipated cash outflows of the business. When we assess a short-term instrument, we must be fluent in translating different yield measures into a common basis for comparison. For example, the yield on a treasury bill is typically quoted on a discount yield basis, whereas a certificate of deposit might use a money market yield. To make sound investment decisions, a treasurer must be able to calculate the bond equivalent yield to normalize these diverse inputs. By understanding the relationship between duration, which measures price sensitivity, and convexity, which refines that measurement for interest rate changes, we can better manage the volatility inherent in our fixed income holdings. Active portfolio management strategies require a clear understanding of how we structure our maturities to meet future liquidity demands. A laddering strategy involves purchasing instruments with staggered maturities, creating a predictable stream of maturing assets that reinforce liquidity. Conversely, a barbell strategy focuses on extremes of the maturity spectrum, holding very short-term assets for immediate liquidity and long-term assets for yield enhancement. Regardless of the chosen structure, rigorous benchmarking against an appropriate index is necessary to gauge if our active management is truly adding value. We must also remain disciplined in our rebalancing efforts, adjusting the portfolio composition as market conditions shift or as the company's own liquidity profile evolves. Measuring performance is not merely about tracking total return, but about ensuring that every unit of risk taken serves a legitimate business purpose in support of the broader corporate objective. Effective treasury management is a complex balancing act that requires both quantitative precision and strategic foresight. I will see you in our next session. Welcome back to our journey through the complexities of corporate treasury. In this section, we move into the critical domain of foreign exchange risk management, where we will dissect how global exposure impacts the bottom line. Understanding foreign exchange, or FX, starts with mastering how currencies are quoted and traded in the global marketplace. A currency quote always involves a base currency and a quote currency, where the base is the primary unit being valued against the quote. For example, in a direct quote, the domestic currency serves as the price for one unit of foreign currency, whereas an indirect quote states the number of foreign currency units per one unit of domestic currency. These conventions determine how treasurers calculate their effective cost of capital and profit margins when dealing with international subsidiaries. Spot rates represent the price for immediate settlement, usually within 2 business days, whereas forward rates incorporate interest rate differentials between two countries to price a transaction for a future date. Mastering the mechanics of these quotations is the foundation upon which all subsequent hedging strategies must be built, because errors in reading a quote translate directly into losses during execution. Once you grasp the quotation structure, you must categorize foreign exchange risk into 3 distinct pillars: transaction, translation, and economic exposure. Transaction exposure is the most immediate risk, occurring when a company has contractual cash flows in a foreign currency that will be settled at a future date, such as an account receivable denominated in euros. Translation exposure is purely accounting-driven, arising from the need to convert financial statements of foreign subsidiaries into the reporting currency of the parent company at the end of a fiscal period. Economic exposure, often considered the most strategic and difficult to quantify, relates to the effect of unexpected currency fluctuations on the present value of a firm's future cash flows. Unlike transaction exposure, which is limited to specific invoices, economic exposure touches the firm's long-term competitive position in its market. Effectively managing these requires a rigorous process of exposure identification, followed by precise quantification to determine the net risk position of the entire enterprise. After identifying the risk, a treasurer must choose between natural hedging and external derivative instruments to mitigate potential losses. External hedging involves financial products like forwards, futures, options, swaps, and currency collars to lock in exchange rates or limit downside while retaining upside potential. Forwards are contractual agreements to exchange currencies at a set rate, while futures offer similar functionality but are traded on standardized exchanges with daily mark-to-market adjustments. Options provide a right but not the obligation to trade at a specific rate, which is useful when cash flows are uncertain, though this comes at a premium cost. Swaps are particularly effective for organizations managing long-term debt across borders because they allow for the exchange of interest and principal payments in different currencies over time. Each derivative instrument carries its own cost-benefit profile, and the selection often depends on the urgency of the hedge and the specific requirements of the Treasury Policy Manual. Beyond sophisticated derivatives, internal techniques remain a powerful, low-cost method to reduce net exposure before reaching out to the banking market. Leading and lagging involve adjusting the timing of payments or collections between corporate entities to take advantage of favorable currency movements. For instance, if a subsidiary expects its local currency to weaken, it may pay its foreign invoices early to avoid a higher cost in the future, while delaying collections from foreign customers. Netting, specifically multilateral netting, reduces the total number of transactions by offsetting payables and receivables across multiple subsidiaries, thereby minimizing the volume of currency to be exchanged. Matching is another effective internal strategy where firms intentionally hold debt in the same currency as the revenue generated by its assets to create a natural cushion against volatility. By integrating these internal techniques with external financial hedging, Treasury departments create a robust defense that protects the integrity of long-term financial statements. I look forward to discussing the next topic with you in our upcoming session. Hello, and welcome to this deep dive into interest rate risk and the strategic frameworks Treasury professionals use to navigate it. In this chapter, we will explore the mechanics of risk exposure and the specific hedging instruments available to manage those vulnerabilities. Interest rate risk represents the potential for changes in market rates to negatively impact a firm's net interest income or the economic value of its equity. When we talk about volatility, we are fundamentally discussing the instability of borrowing costs and investment returns over time. A critical diagnostic tool for Treasury professionals is the yield curve, which maps interest rates against different maturities. A normal yield curve is characterized by upward-sloping lines, reflecting the expectation that longer-term investments require higher yields to compensate for uncertainty. Conversely, an inverted yield curve, where short-term rates exceed long-term ones, often signals market anticipation of an economic slowdown. A flat yield curve suggests little variation between short and long durations, often occurring during periods of economic transition. Understanding these shapes requires looking at the expectations theory, which posits that long-term rates are simply a composite of expected future short-term rates. The liquidity preference theory adds a necessary dimension by arguing that investors demand a premium for holding assets that are harder to liquidate. Finally, market segmentation theory suggests that interest rates are determined by supply and demand within specific maturity buckets, independent of other segments. To effectively manage these risks, a treasurer must first identify the specific nature of the exposure through gapping analysis and sensitivity testing. Gapping analysis involves categorizing assets and liabilities by their maturity or repricing dates to determine the net exposure in specific time buckets. If a company has more interest-sensitive liabilities than assets maturing in a particular window, it is considered liability-sensitive and vulnerable to rising rates. Sensitivity testing further refines this by calculating exactly how a move in basis points affects the bottom line, often distinguishing between the impact on earnings and the broader impact on the market value of equity. A common trap is ignoring basis risk, which occurs when the interest rate indices used for assets do not move in perfect lockstep with the indices for liabilities. For instance, if your company borrows based on a fluctuating commercial paper index, but earns interest based on a different benchmark, a divergence in these two rates creates an unhedged exposure. Duration gap management seeks to mitigate this by aligning the weighted average maturity of assets with those of liabilities to neutralize the impact of rate shifts on the balance sheet. Once the risk profile is quantified, the treasurer must decide whether to accept the exposure or utilize hedging instruments to transfer that risk. External hedging tools provide the primary solution, with interest rate swaps standing out as the most widely used contract. In a basic swap, a firm might pay a fixed rate and receive a floating rate, essentially converting a variable rate debt obligation into a synthetic fixed rate liability. If you anticipate rates will rise, locking in a lower fixed rate now through a swap can stabilize future interest expenses. When companies want to hedge against specific rate movements without losing the benefit, if rates go in their favor, they turn to caps, floors, and collars. An interest rate cap limits the maximum interest a borrower must pay on floating rate debt, while a floor provides a minimum return on investments. A collar combines these two, setting a range for the interest rate that limits both the upside and downside risk, often at a lower cost than a standalone cap. Forward rate agreements and financial futures contracts function by locking in a future interest rate for a specific principal amount, allowing firms to hedge upcoming debt issuances or refinancing activities. Managing a debt portfolio requires a persistent focus on optimizing the mix between fixed and floating rate debt to align with the firm's broader risk appetite. While fixed rate debt offers the security of predictable cash flows, it can become expensive if market rates trend significantly downward. Floating rate debt offers the benefit of capturing lower market rates, but it leaves the company dangerously exposed during cycles of tightening monetary policy. Treasury departments must also consider the regulatory and capital implications, especially for organizations subject to bank-like capital adequacy requirements. Large interest rate fluctuations that significantly degrade market value can trigger regulatory interventions or force a firm to adjust its capital structure to maintain standard ratios. Integrating these hedging strategies requires a systematic approach to forecast rate movements, assess debt profiles, and execute derivatives that align with the company's liquidity goals. By strictly applying gapping analysis and utilizing the appropriate derivative products, you ensure that the cost of capital remains within predefined variance limits, protecting both the income statement and the strength of the balance sheet. I look forward to continuing our discussion in the next lesson. Welcome back to our exploration of the Treasury domain, where today we shift our focus toward the comprehensive discipline of enterprise risk management. This entire chapter is dedicated to navigating the systemic frameworks that allow an organization to identify, evaluate, and mitigate risks across the entire corporate structure. Enterprise risk management, or ERM, represents a shift from managing isolated silos of risk toward a holistic perspective that integrates risk response into the broader strategic goals of the firm. By adopting a structured framework such as the COSO ERM Integrated Framework or the ISO 31000 standard, a Treasury professional creates a common language for risk that transcends individual departments. The primary goal is not necessarily to eliminate risk, but to understand its potential to obstruct value creation so that management can make informed decisions. We look at risk through a lens that encompasses both the upside of taking calculated risks and the downside of failing to contain threats. This discipline requires constant vigilance, transforming risk assessment from a periodic task into an ongoing, dynamic process of organizational health. To implement this effectively, we must first establish the clear distinction between risk appetite and risk tolerance, as these concepts define the boundaries of acceptable behavior. Risk appetite is the broad level of risk an organization is willing to accept in pursuit of its primary objectives, reflecting its overall mission and culture. Risk tolerance, conversely, is the specific, often quantifiable, variation in outcomes that the firm can endure regarding particular objectives or individual projects. If you are launching a new international branch, your appetite defines your willingness to enter emerging markets, while your tolerance sets the maximum percentage loss on capital that you can handle before requiring intervention. Maintaining this boundary requires rigorous identification of factors like operational failures, human error, or legal noncompliance that could push the firm outside its defined safety zone. When we identify a threat, our response usually falls into four categorical strategies: avoidance, transfer, mitigation, or acceptance. Avoidance implies exiting the activity entirely, which is safe but often precludes any return on investment, while transfer shifts the burden of risk to a third party through mechanisms like insurance or hedging instruments. Mitigation focuses on reducing either the likelihood or the impact of a risk event through internal controls, improved technology, or rigorous staff training. Finally, acceptance is a deliberate decision to retain the risk without external intervention, usually reserved for events where the cost of control exceeds the potential loss. The efficacy of these strategies is tested during crisis management and business continuity planning, where the focus moves from conceptual frameworks to execution. Operational risk in this context is frequently manifested through systemic vulnerabilities, such as potential failures in legacy software or the catastrophic impact of sophisticated cyber attacks. These technical failures, combined with the perennial risk of human error, demand a robust disaster recovery protocol that goes beyond simple data backups. It includes clear communication hierarchies and defined roles, ensuring that when a process breaks down, the response is swift and coordinated rather than panicked. If a treasury management system stops communicating with the primary banking gateway, your BCP must have a manual, reliable fallback to ensure that daily liquidity operations continue. This ensures that a local operational failure does not propagate into a broader liquidity crisis that impairs the firm's reputation or regulatory standing. Insurance and self-insurance strategies represent our primary mechanisms for financial risk transfer, allowing the firm to distribute losses that cannot be reasonably mitigated. Many large organizations establish captive insurance companies, which are essentially wholly owned subsidiaries created to underwrite the risks of the parent firm, providing insurance that might be prohibitively expensive in the commercial market. The mathematical verification of these risks is handled through quantitative tools that allow for a degree of predictive accuracy. Value at risk, or VR, provides a statistical estimate of the maximum potential loss over a specific time frame, while stress testing and scenario analysis help us understand how our portfolio might behave under extreme, albeit improbable market conditions. These metrics are essential for reporting to senior management who require concise, actionable insights rather than granular, confusing datasets to guide institutional strategy. I will see you in the next lecture. Welcome to this deep dive into advanced derivatives and hedging. where we examine the complex instruments and regulatory infrastructure essential for modern Treasury risk management. We will move beyond basic concepts to scrutinize valuation models, documentation standards, and the rigorous criteria required for hedge accounting. Derivative instruments operate on the fundamental premise of transferring risk from one party to another, often by isolating specific market exposures like interest rates or currency volatility. At the core of pricing these instruments lies the Black-Scholes model, which calculates the theoretical value of options by evaluating underlying asset prices, strike prices, time to expiration, and current volatility. Practitioners must understand the Greeks, which are the sensitivity parameters that quantify how an instrument's value changes in relation to market variables. Delta represents the sensitivity to the underlying price, while gamma measures the rate of change in delta. Theta captures the impact of time decay. Vega addresses volatility sensitivity, and rho relates to interest rate fluctuations. These metrics are not merely academic concepts. They serve as the primary tools for portfolio managers to maintain a neutral risk posture or to adjust their hedge ratios in evolving markets. The market structure of derivatives is bifurcated into exchange-traded instruments and over-the-counter, or OTC, contracts. Exchange-traded derivatives are characterized by high levels of standardization, which facilitates liquidity and transparent pricing through centralized clearinghouses. Conversely, OTC derivatives allow for customization, enabling Treasury departments to tailor contracts to specific hedge requirements that standard instruments cannot satisfy. This flexibility, however, introduces significant counterparty credit risk, necessitating robust documentation and collateral management frameworks. The International Swaps and Derivatives Association, or ISDA, provides the industry standard master agreement, which governs the legal relationship between counterparties. This framework is further fortified by the Credit Support Annex, or CSA, which dictates the collateral requirements and margin movements between parties to mitigate potential defaults. Hedge accounting serves as the bridge between market reality and financial reporting, allowing treasurers to align the accounting treatment of a hedge with the underlying economic risk being mitigated. According to standard accounting criteria, an entity must demonstrate high correlation between the hedged item and the hedging instrument to qualify for favorable reporting. There are three primary classifications: fair value hedges, which address fluctuations in the value of recognized assets or liabilities; cash flow hedges, which insulate against variability in expected future cash flows; and net investment hedges, which protect against foreign currency translation risk. Effectiveness testing is a continuous requirement, as treasurers must periodically assess whether the hedge achieves its intended mitigation. If the relationship ceases to meet effectiveness testing criteria, the entity must proceed with de-designation, which often triggers immediate financial statement volatility. Internal control environments must distinguish clearly between speculative activity and legitimate hedging to satisfy both board-level mandates and regulatory oversight. A Treasury policy should explicitly codify the authorization levels for derivative transactions, setting strict limits based on notional volume, risk-adjusted value, and counterparty credit lines. Continuous monitoring requires rigorous credit risk analysis of all counterparties, especially when utilizing credit default swaps to transfer or manage credit exposure. These swaps act as insurance policies against the event of default, but they introduce their own complexities regarding basis risk and valuation. Organizations must ensure that the risks inherent in these derivative strategies are fully understood by management, documented within the internal control framework, and reconciled against the company's stated appetite for volatility. Maintaining compliance in this domain requires a persistent focus on both the accuracy of valuation models and the legal sanctity of the underlying documentation. I look forward to our next discussion as we continue to build our professional acumen. Welcome to the chapter on corporate governance and ethics, where we will examine the structural frameworks and ethical imperatives governing modern Treasury functions. By mastering these concepts, you will gain the clarity required to navigate complex organizational landscapes and position yourself as an indispensable asset to your firm. Effective corporate governance starts at the top, with the board of directors establishing the oversight mechanisms that dictate how Treasury operates. You must view the board not merely as a high-level authority, but as the entity responsible for defining the risk appetite and strategic direction of the enterprise. Within this structure, Audit committees and specific Treasury committees serve as critical control layers, ensuring that financial policies are both robust and consistently applied. Policies and procedures are the practical manifestations of board-level intent, providing the necessary boundaries for daily operations. If these controls are missing or ambiguous, you inevitably invite operational risk, which can quickly spiral into financial loss or reputational damage. Therefore, every Treasury professional should understand the importance of a well-defined control framework that dictates how capital is managed and protected. A cornerstone of sound Treasury governance is the segregation of duties, a concept that is often discussed but occasionally misunderstood in practice. The core idea is that no single individual should have the capability to initiate, authorize, and reconcile any financial transaction without oversight. By separating the front office, which executes trades, from the back office, which settles and reconciles those trades, an organization introduces a necessary point of friction that prevents fraud and error. This is usually enforced through a structured hierarchy known as the limits of authority, or LOA. In this regime, your ability to commit firm capital is clearly capped based on your role, preventing unauthorized exposure to markets or excessive counterparty risk. When internal audit collaborates effectively with Treasury, they act as the final defense, verifying that these control frameworks are not merely documents on a shelf, but operating realities in the high-frequency environment of Treasury. Professional ethics and Treasury management are rarely about finding a gray area to exploit. Rather, they are about maintaining the integrity of the capital markets and the trust of institutional investors. Conflicts of interest are perhaps the most common ethical hurdle, requiring you to be hyper-aware of situations where personal gain might intersect with corporate decision-making. You must manage price-sensitive information with extreme caution, as the implications of leaking non-public data are severe, both for your career and for the firm's legal standing. Insider trading prevention is not just a regulatory checklist. It is an organizational culture that rejects the temptation of illicit gains for long-term sustainability. Whistleblower policies provide the necessary safety valve for employees to report irregularities without fear of retaliation, which is an essential component of a transparent corporate environment. When you prioritize ethical behavior, you foster an internal culture of accountability that inevitably strengthens the firm's relationship with its stakeholders. The modern Treasury has also seen a shift toward integrating environmental, social, and governance, or ESG, factors into its core strategy. This is not purely a marketing exercise or a regulatory constraint. It is a fundamental shift in how institutional investors evaluate the long-term creditworthiness of your firm. By considering ESG metrics in investment portfolios or when structuring green bonds, Treasury teams directly influence the company's cost of capital and its standing in the global market. Sustainable financing options, such as socially responsible investment, allow Treasury to align the firm's financial operations with its broader corporate social responsibility goals. Credit rating agencies now explicitly include these factors in their assessments, meaning that poor environmental or social governance can directly impact your financing capability. As you progress, understanding this integration is crucial for any strategist who aims to manage liquidity while simultaneously securing the firm's reputation in an increasingly transparent and scrutinized global economy. I will see you in the next lecture. Welcome to our exploration of strategic treasury planning and its integration into the broader corporate framework. In this chapter, we will master the transition from operational cash management to high-level strategic alignment that drives long-term organizational value. Effective treasury management today requires a fundamental shift in perspective where the function moves from being a mere back-office utility to a strategic value center. Truly aligning treasury activities with corporate strategy means that every decision, from capital allocation to liquidity management, is made to support the specific business model of the firm. When a corporation pursues an expansion strategy or engages in mergers and acquisitions, the Treasury Department provides the analytical backbone necessary for informed decision-making. This involves conducting rigorous Treasury due diligence to identify potential financial risks or operational inefficiencies in the target company before the deal is finalized. Integration planning after an acquisition is equally critical, as it requires harmonizing cash management workflows, systemic frameworks, and funding structures to ensure the combined entity realizes its expected synergies. Failing to account for these post-acquisition realities often results in liquidity bottlenecks or unnecessary increases in the cost of capital. As the firm grows, the organizational structure of Treasury must evolve to maintain efficiency, leading many organizations to explore shared service centers or dedicated in-house banking arrangements. An in-house bank serves as an internal intermediary that manages intercompany funding, netting, and currency exposure, effectively reducing the need for external bank interaction and lowering banking fees. While these models offer significant benefits in terms of centralized cash control and improved visibility, they also introduce complexities related to regulatory compliance and tax implications. When establishing such structures, professionals must carefully consider transfer pricing policies to ensure they remain compliant with local tax authorities while optimizing the global tax position of the corporation. Developing a central treasury maturity model allows the finance team to benchmark their current processes against global best practices and identify exactly which technological or structural improvements will deliver the highest return on investment. Strategic long-term capital planning is arguably the most complex responsibility of a modern treasurer, as it requires anticipating market shifts and interest rate environments years in advance. By maintaining a robust strategic funding plan, the organization ensures that it can access capital markets when conditions are favorable, rather than being forced into financing arrangements during turbulent periods. Treasury departments that succeed in this environment view themselves as internal advisors to the chief financial officer, providing data-driven insights that influence boardroom strategy and capital budgeting. Driving innovation in financial operations through automation and advanced data analytics allows the Treasury to focus more on value creation metrics rather than routine transaction processing. Ultimately, the integration of these Treasury functions ensures that the firm remains agile and well-positioned to fund future growth while mitigating risks that could threaten its capital structure. As you progress through this section, focus on the interconnectedness of these strategic choices and how they reinforce each other to stabilize the corporate entity. I look forward to our next session. Welcome back. In this chapter, we will master the intricacies of bank account analysis, ensuring you can decode statements and optimize your banking relationships effectively. To manage a corporate treasury function effectively, one must treat bank account analysis statements not merely as bills, but as rich data sets that reveal hidden costs and operational efficiencies. These statements summarize the services provided by your financial partners, charging specific fees based on standardized AFP service codes. Understanding these codes is the first step toward invoice reconciliation, as they provide a common language between the bank and your treasury department. When you examine a statement, you are looking at a granular breakdown of balances, volumetric data, and applied rates that dictate your cost of banking. It is not uncommon for treasury professionals to discover discrepancies in these statements, making the ability to audit them directly proportional to the cash savings you can realize. By mastering the language of these statements, you move from being a passive recipient of fees to an active manager of banking costs. The foundation of managing banking costs rests on the interplay between service charges and earnings credit rates. Banks often allow companies to offset service fees by maintaining compensating balances, which the bank then invests to generate income. The earnings credit rate, or ECR, is the interest rate applied to these average collected balances to determine the amount of credit available to pay for services. Since the ECR is often a negotiated variable rate, you must compute the investable balance by subtracting required reserves from your average ledger balance, adjusted for float. Keep in mind that regulators often mandate that a portion of these deposits be held as non-interest earning reserves, which effectively lowers the core balance available to generate credit. Calculating this accurately involves applying the formula where the investable balance is multiplied by the ECR and then divided by the number of days in the year. If the calculated earnings credit fails to cover your service charges, the bank will levy a direct fee for the difference. Analyzing the effectiveness of your banking strategy requires a deeper look at the relationship between price, volume, and variance. A price-volume analysis is a disciplined process that compares your actual service volumes against the expected patterns you established in your service level agreements, or SLAs. When you see a significant variance in specific service categories, such as wire transfers or lockbox processing, you need to investigate the underlying operational cause. Is it a change in customer behavior, a drift in internal payment processes, or perhaps an error in the bank's processing system. By benchmarking these costs against regional peers or standardized industry data, you establish a baseline that allows for informed negotiation. You should approach your bank not as a vendor who sets arbitrary prices, but as a partner whose output is subject to rigorous audit and competitive scrutiny. Clear SLAs ensure that performance standards are met, providing a safety net when service levels begin to degrade. Beyond the technical calculation of fees, you must maintain a strategic oversight of your global banking portfolio. This involves rationalizing the number of accounts you hold, as each active account represents a potential point of failure, increased regulatory risk, and unnecessary administrative overhead. Closing dormant accounts is standard practice, yet it requires careful coordination with internal accounting teams to ensure that all automated clearinghouse, or ACH, and wire instructions have been migrated to the remaining active accounts. Furthermore, counterparty risk and credit quality monitoring are paramount when you decide where to hold corporate liquidity. You should diversify your banking partners to avoid over-reliance on a single institution, especially in an era of sudden market volatility. Finally, never overlook the compliance aspect of this role, particularly regarding the reporting of foreign bank and financial accounts, known as FBAI. Maintaining strict adherence to reporting requirements is essential, as the cost of regulatory non-compliance far outweighs any potential savings from service fee optimization. See you in the next lesson. Welcome back. In this chapter, we explore advanced cash management optimization, focusing on how large organizations consolidate liquidity, manage cross-border complexities, and leverage modern messaging standards to drive operational efficiency. When we approach cash management at a global scale, the primary objective is to transcend the limitations of fragmented banking relationships. Cross-border cash pooling is a fundamental technique for this, allowing a multinational corporation to concentrate balances from various local subsidiaries into a central header account, typically held in a regional treasury center. This structure reduces the need for external borrowing by utilizing internal idle cash from surplus entities to fund those in deficit, effectively minimizing interest expenses across the enterprise. However, these systems are rarely straightforward because they must navigate conflicting tax jurisdictions and legal restrictions that may limit the free movement of capital. For instance, some countries impose stringent withholding taxes or thin capitalization rules that make intra-company lending agreements a necessity rather than an optional administrative exercise. By formalizing these lending arrangements, Treasury teams establish a clear transfer pricing framework that satisfies local regulatory requirements while maintaining the structural integrity of the cash pool. Beyond structural pooling, optimizing the physical movement of funds requires a deep understanding of float management and availability schedules. Historically, cash in transit served as a buffer, but modern Treasury functions aim to eliminate this friction through aggressive collection speed improvements and electronic automation. A central element here is the transition to standardized messaging formats, specifically the adoption of ISO 20022 and XML-based communication. Unlike older proprietary bank formats, ISO 20022 provides a data-rich structure that carries comprehensive remittance information directly alongside the payment instruction. This transition significantly enhances straight-through processing rates, as the automation of reconciliation strategies no longer depends on manual matching of cryptic reference fields. When we can reliably reconcile incoming payments automatically, we reclaim FTE hours and gain a higher degree of granular visibility into our daily liquidity position. To achieve a true global cash view, Treasury departments often deploy aggregator services that function as a virtual overlay on top of disparate banking platforms. These tools pull various local banks to deliver near real-time balance reporting, which is essential for informed decision-making in a high-interest or volatile exchange rate environment. By consolidating accounts and utilizing these aggregators, a Treasury organization can drastically reduce bank fees that often proliferate in decentralized operational models. Global cash visibility is not merely about seeing the numbers. It is about enabling the Treasury to act as an internal bank for the corporate group. As we integrate these technologies, we move away from reactive liquidity management toward a proactive model where cash is optimized at the point of origin. Understanding the intersection of technical standards like XML messaging and the regulatory requirements of regional treasury centers will be a recurring theme as we refine these processes throughout this section of the course. See you in the next lecture. Welcome back. In this lesson, we will move beyond basic liquidity ratios to explore advanced working capital analytics that drive strategic corporate decision-making. When we analyze working capital, we often rely on standard metrics like the cash conversion cycle, which provides a high-level view of operational efficiency. However, true treasury mastery requires the application of statistical process control to these metrics, treating working capital flows as a repeatable production process rather than a static balance sheet item. By applying trend analysis to our receivables and inventory turnover, we can distinguish between systemic improvements in operational performance and mere seasonal noise. Furthermore, identifying the statistical correlation between sales growth and inventory accumulation allows us to determine if our current investment in stock is scaling efficiently or if capital is being tied up in obsolescence. These analytical layers bridge the gap between simple accounting reports and actionable, data-driven treasury management that can foresee shifts in cash availability before they hit the financial statements. Moving into the realm of supply chain finance, we encounter sophisticated tools like reverse factoring, which fundamentally alters the relationship between the buyer, the supplier, and the financing bank. In a traditional supply chain engagement, the supplier bears the cost of financing their own receivables, often at an interest rate dictated by their own credit rating. Through reverse factoring, a credit-worthy buyer allows their suppliers to access capital at the buyer's preferential financing rate, creating a mutually beneficial environment that stabilizes the supply base while preserving the buyer's own cash. To calculate the efficacy of these programs, one must look at dynamic discounting algorithms, which model the trade-off between the cost of capital and the value of early payment incentives. These calculations are not merely transactional, but reflect the underlying strategy of optimizing the enterprise's weighted average cost of capital while simultaneously strengthening long-term vendor partnerships. The impact of these optimization strategies is most clearly visible in the broader context of enterprise value and stock price sensitivity. Analysts and rating agencies do not just look at raw liquidity. They evaluate the quality and reliability of cash flows as a proxy for the firm's ability to survive economic volatility. When a firm initiates aggressive working capital management, it often directly influences its free cash flow yield, which is a primary driver in discounted cash flow valuations. Because the market reacts to predictability, a treasury function that can demonstrate consistent liquidity management is often rewarded with a lower risk premium and, by extension, a more favorable cost of debt. This sensitivity means that every day of reduced working capital translates into tangible value creation that stakeholders expect to see reflected in the firm's overall market capitalization and external credit metrics. Finally, we must address the structural complexities of managing working capital in a global environment where capital is not always fungible. Foreign subsidiaries often face regulatory hurdles, capital controls, or high tax environments that result in trapped cash, preventing the efficient redeployment of liquidity to the parent company. Effective repatriation strategies, such as intercompany lending or royalty payments, must be handled with precise tax planning to avoid eroding the value of the funds we seek to mobilize. During an economic downturn, this challenge becomes acute, as the Treasury must defend liquidity against shrinking margins while ensuring that restricted funds are not left idle in jurisdictions where they cannot support the broader corporate strategy. Mastering these advanced concepts requires a rigorous approach to data, an understanding of regional regulation, and a constant focus on the preservation of shareholder value through disciplined financial stewardship. I look forward to our next session. Welcome to the Treasury Systems Implementation Roadmap, where we will examine the life cycle of selecting and deploying a treasury management system. Through this chapter, you will master the strategic transition from manual processes to automated financial architecture, ensuring you can deliver lasting value to your organization. Building a business case for a treasury management system begins with a rigorous return on investment analysis that transcends surface-level savings. You must account for the total cost of ownership, including licensing, implementation fees, and the ongoing operational maintenance of the software. A thorough cost-benefit comparison often reveals that the true value lies in the reduction of manual error rates and the enhancement of real-time visibility into global liquidity. When presenting this to stakeholders, focus on the mitigation of operational risk and the efficiency gains derived from automated bank reconciliation. It is helpful to treat this not merely as an IT project, but as a fundamental shift in how the Treasury Department consumes and processes financial data. By quantifying the time saved by Treasury staff, you establish a baseline that justifies the capital expenditure required for sophisticated technology. Remember that the selection process is where many projects fail before they even begin due to poorly defined requirements. Always prioritize technical scalability over the allure of trendy features that lack a clear connection to your specific Treasury workflows. The heart of the selection process is the request for proposal, which acts as the mirror reflecting your operational needs back to potential vendors. Developing a robust RFP requires documenting current pain points and future state requirements with granular detail. Once the proposals are in, vendor demonstrations should be conducted using scripted scenarios that force providers to show how their system handles your actual daily bank files. I recommend using a weighted scorecarding system to evaluate these demonstrations, ensuring that a single wow feature does not overshadow critical deficiencies in security or reporting. You must also decide between a software as a service delivery model and an on-premise installation based on your organization's internal infrastructure capabilities and appetite for cloud-based data storage. While SaaS typically offers lower initial barriers and faster updates, on-premise solutions might satisfy restrictive internal security mandates that prioritize complete physical control over hosting hardware. Regardless of the deployment path, the implementation methodology deserves as much attention as the software itself. Choosing between agile and waterfall implementation methodologies often depends on the complexity of your legacy integration. Waterfall provides a predictable, phase-gated approach that works well when the requirements are highly stable and the scope is strictly defined from the outset. Conversely, agile methodologies allow for iterative development, which can be advantageous if you are building complex API architectures that require frequent testing and refinement. Data conversion is almost always the most underestimated aspect of any implementation project. Mapping data from your legacy systems to the new environment requires cleaning historical files and ensuring that custom fields are correctly translated to avoid corrupting your forward-looking analytics. You will spend a significant portion of your project timeline performing user acceptance testing, where you must validate that the system correctly translates bank statements and calculates positions as expected. Never skimp on this phase, as missing a minor data mapping error here will manifest as a significant reporting failure after your go-live date. Once the system is live, the focus must immediately pivot to long-term security, administration, and continuous improvement. You must implement granular user access controls that follow the principle of least privilege, ensuring that users only have the permissions necessary to perform their specific duties. Furthermore, audit trails must be active and monitored to provide a comprehensive log of every action taken within the Treasury ecosystem. Modern Treasury technology is evolving rapidly, with machine learning and robotic process automation shifting from buzzwords to practical tools for high-volume tasks like payment reconciliation and fraud detection. Future-proofing your system means selecting a vendor that prioritizes open API architecture, allowing you to integrate with evolving banking protocols without needing to replace the entire core system every few years. Periodically review your system performance against your initial business case to identify if you are actually achieving the efficiency gains you projected. A commitment to continuous improvement ensures that the Treasury function remains a strategic partner to the business rather than a static cost center. I look forward to seeing you in the next lecture. Welcome back. In this lesson, we explore the diverse landscape of corporate financing strategies and the alternatives available for modern Treasury operations. Asset-based lending serves as a foundational financing tool where liquidity is secured directly against specific collateral, such as accounts receivable, inventory, or equipment. Unlike unsecured credit, this approach grants the lender a direct claim on assets, which often facilitates financing for corporations that might not meet traditional credit rating thresholds. Factoring involves the outright sale of accounts receivable to a third party at a discount, providing immediate cash inflow and offloading the credit risk associated with those specific receivables to the factor. Forfeiting goes a step further by involving the purchase of medium to long-term receivables, usually related to international trade, which are often backed by a bank guarantee. These techniques demonstrate how shifting the liquidity profile of specific assets can effectively unlock capital that would otherwise remain tied up in the cash conversion cycle. By converting illiquid assets into immediate operational funds, Treasury teams can enhance their overall liquidity position without necessarily increasing the underlying corporate debt load or relying on institutional credit lines. Securitization of receivables remains a sophisticated mechanism where a corporation pools various financial assets and packages them into tradable investment securities. This structural evolution allows the firm to move assets off the balance sheet, potentially reducing the required capital ratio and improving return on assets. Leasing offers an alternative to capital expenditure by allowing firms to gain the right to use an asset without the immediate cash outlay required for ownership. The tax implications of leasing are significant, as they often enable the deduction of rental payments as operating expenses rather than depreciation of an owned asset, which impacts the net income and taxable position of the firm differently. From a balance sheet perspective, the distinction between operating and finance leases dictates how liabilities are calculated under modern accounting standards. Treasurers must analyze whether the tax benefits and liquidity preservation of leasing outweigh the potential loss of residual value that comes with asset ownership at the end of the term. Debt covenant management represents a critical aspect of sustained financial flexibility, necessitating consistent, proactive monitoring of all performance metrics agreed upon with creditors. Covenants act as guardrails, and failing to adhere to specified interest coverage ratios or leverage maximums can trigger technical defaults that cripple operational authority. Effective compliance reporting requires a robust internal control pipeline that provides the Treasury Department with real-time visibility into the current standing of these financial ratios. When market conditions shift or operational performance deviates from original projections, the Treasury function must be prepared for the process of negotiating covenant waivers. This process is inherently adversarial and requires a transparent communication strategy to demonstrate that the underlying entity remains fundamentally solvent despite the temporary breach. Proactive communication with banking partners often creates the necessary rapport to secure concessions before the breach actually affects the firm's credit rating or cost of capital. Alternative lending platforms have emerged to challenge the traditional hegemony of commercial banks, providing access to capital through peer-to-peer mechanisms and structured crowdfunding. Private debt markets provide a flexible substitute for traditional syndications, often allowing customized repayment schedules that bridge the gap between bank loans and equity issuance. Mezzanine financing fills the void between secured debt and common equity, frequently incorporating hybrid features such as warrants or convertible options. Convertible bonds represent a classic hybrid instrument, offering the investor the benefit of fixed income protection coupled with the upside potential of equity participation upon conversion. These tools are increasingly being influenced by green and sustainable financing frameworks that tie the cost of capital to the achievement of defined environmental or social milestones. For the treasurer, navigating these alternatives requires a balance between the lower cost of standard debt and the strategic flexibility afforded by more complex hybrid instruments. Project finance differs significantly from corporate borrowing by utilizing special purpose vehicle structures that ring-fence the assets and cash flows of a single infrastructure initiative. This limited recourse financing ensures that the parent corporation's own balance sheet remains insulated from the project's potential failure, which is a vital consideration for high-risk international ventures. Export credit agencies serve as an essential backbone in this domain by providing guarantees and insurance that mitigate the political and commercial risks inherent in cross-border trade. By partnering with these agencies, companies can access more favorable funding terms and effectively distribute the burden of capital expenditure across multiple stakeholders. Such arrangements require deep legal and financial coordination to ensure that the structural integrity of the special purpose vehicle satisfies both the project lenders and the parent company's risk appetite. As global infrastructure demand continues to grow, the ability to architect these limited recourse structures will remain a competitive differentiator for Treasury leadership. See you in the next lecture. Welcome to this module on International Treasury and Growth, where we will examine the complexities of global cash management and cross-border financial operations. Throughout this section, we will cover the essential pillars of operating in emerging markets, tax efficiency, and the structural design of global liquidity management to ensure you excel in your professional role. Expanding operations into emerging markets introduces a distinct set of challenges that are often absent in developed economies. The primary concern is currency convertibility, where a treasury professional must assess whether local funds can be reliably swapped for a major base currency like the USD or Euro. Furthermore, capital controls frequently dictate the flow of money, often limiting the ability of a subsidiary to move cash freely back to the parent company. When companies deal with the repatriation of funds, they must navigate a landscape of local banking regulations that often clash with global internal standards or common treasury policies. Managing these international subsidiaries requires a balanced hand that respects local nuances while maintaining central visibility and control over financial resources. A successful treasurer must balance these operational constraints against the necessity of maintaining enough liquidity on the ground to support local business growth. Tax efficiency remains a cornerstone of international treasury, primarily manifesting in the choice between operating in tax havens or jurisdictions with high tax burdens. The existence of double taxation treaties is a critical mechanism here, as these agreements prevent the same income from being taxed twice by different sovereign entities. Closely related to this is the impact of withholding tax on interest and dividend payments made between an offshore entity and a parent company. To optimize these flows, many organizations implement offshore in-house banking, creating an internal ecosystem that mimics external banking services to manage cross-border intercompany balances. Efficient global liquidity structures, often relying on notional pooling or physical sweeping, allow treasurers to centralize surplus cash, reducing the cost of external borrowing and improving overall yield. The tension between centralized and decentralized decision-making is constant, as the desire for control at headquarters often competes with the agility needed by local offices. Standardization of procedures is essential for maintaining compliance and operational oversight, especially regarding cultural differences in payment practices. In some regions, electronic transfers are the standard, while in others, paper-based instruments or specific local clearing systems remain dominant. Global account rationalization is a pragmatic step to reduce the complexity and costs associated with managing a sprawling network of local bank relationships. During this cleanup process, entity management becomes vital, ensuring every branch or subsidiary remains in compliance with varying regulatory requirements globally. The Legal Entity Identifier, or LEI, has become a mandatory component in this regulatory landscape, providing transparency in financial transactions involving legal entities. By maintaining accurate identification, Treasury departments ensure that they are not only meeting local transparency laws, but also facilitating smoother trade finance activities. Global trade finance instruments, such as letters of credit and bank guarantees, act as the connective tissue for cross-border commerce by mitigating counterparty risk. These instruments are governed by rigorous frameworks like the UCP 600 rules, which provide standardized procedures for the handling of digital and physical documentation in commercial transactions. Understanding these rules is a professional requirement for anyone involved in import or export activities, as even minor discrepancies can lead to significant liquidity delays. International cash positioning challenges arise fundamentally from the latency in reporting and the variability of international banking interfaces, which can make real-time visibility difficult to achieve. By grounding your strategy in these standardized frameworks and understanding the levers of international tax and cash flow, you move from merely reacting to local problems into a role that proactively shapes the financial architecture of a multinational enterprise. I look forward to discussing these concepts further in the upcoming session. Welcome back. In this chapter, we are going to explore the critical pillars of fraud prevention and the essential internal control frameworks required to safeguard corporate treasury assets. Building a robust internal control environment begins with the fundamental principle of segregation of duties, which acts as the first line of defense against both error and intentional malfeasance. By ensuring that no single individual has control over the entire life cycle of a financial transaction, you effectively distribute risk across different roles and responsibilities. This requires a carefully designed approval matrix where authorization limits are clearly defined and enforced through system-level configurations. Furthermore, user access reviews must be conducted at regular, recurring intervals to ensure that permissions remain aligned with current job functions, especially following staff departures or internal role transitions. Independent verifications serve as a vital secondary check, where a separate party confirms the validity of a transaction before it is finalized or executed in the ledger. When these digital controls are coupled with rigorous physical security and asset safeguarding measures, the Treasury Department creates a fortified environment that is significantly harder to compromise. The external threat landscape, particularly regarding cyber fraud, demands that Treasury professionals move beyond static defenses toward a more dynamic and layered security posture. Cyber threat actors frequently employ sophisticated social engineering tactics designed to manipulate authorized staff into initiating unauthorized payments or disclosing sensitive credentials. To mitigate these risks, organizations must implement mandatory multi-factor authentication across all banking portals and administrative interfaces, ensuring that a simple password compromise does not lead to a total account takeover. Encryption remains a non-negotiable standard for all data in transit and at rest, protecting sensitive payment instructions from interception by malicious third parties. We also advocate for the use of hardened workstations, which are strictly limited to necessary Treasury functions and locked down to prevent the use of unauthorized software or external hardware. By enforcing these technical controls, Treasury teams provide an essential barrier that neutralizes many common automated attack vectors. Operational integrity is strictly maintained through the adoption of dual control requirements, particularly for sensitive payment activities like wire transfers or high-value ACH transactions. This means that at least two individuals must participate in the initiation, verification, and final release of every payment, thereby minimizing the possibility of a single person executing a fraudulent request. Organizations should rely heavily on the security features provided by their bank's self-service portals, which often include advanced monitoring and customizable alert settings that provide real-time updates on unusual account activity. Daily reconciliation is not merely an accounting best practice, but a primary detection tool that allows the team to identify discrepancies before they manifest into significant operational losses. When a discrepancy is detected, the process of investigating it must be swift and structured, ensuring that the root cause is identified and remediated without delay. Proactive fraud prevention tools are available through most commercial banking partners, and leveraging them is a core responsibility for any Treasury professional seeking to minimize exposure. Positive pay services represent one of the most effective ways to prevent check fraud, as banks match the details of presented checks against an issued file provided by your system. Similarly, ACH block and filter tools allow you to restrict account debits to known authorized partners, which effectively eliminates unauthorized ACH withdrawals from cropping up unexpectedly on your statement. Beyond the technology, the human element remains a critical point of failure or success, necessitating comprehensive employee training and awareness programs to educate staff on the latest fraud schemes. A mature organization will also have formal reporting mechanisms and well-defined internal audit cycles to test the effectiveness of these controls against real-world scenarios. Finally, when a breach does occur, having a pre-established fraud response plan and a clear strategy for legal action and recovery steps can significantly reduce the ultimate financial and reputational impact of the incident. I will see you in the next lecture. Welcome to our session on critical treasury calculations, where we will synthesize the mathematical frameworks necessary for your certification success. We are focusing today on the quantitative rigor required to pass the exam, ensuring you can apply these formulas under pressure. The foundation of treasury mathematics rests on the time value of money, which allows us to compare cash flows occurring at different points in time. When dealing with present value and future value, we are essentially discounting or compounding cash flows based on a specific interest rate. An annuity calculation represents a series of equal payments at regular intervals, and understanding the difference between ordinary annuities and annuities due is vital for accurate valuation. Moving to the cost of capital, the weighted average cost of capital, or WACC, aggregates the cost of equity and debt based on target capital structure weights. The capital asset pricing model remains the primary tool for estimating the cost of equity, requiring the risk-free rate, beta, and the equity risk premium. Debt costs are usually easier to pin down, as they are based on current market interest rates and adjusted for the corporate tax shield. Mastery of these components is non-negotiable for any finance professional aiming to evaluate capital budgeting decisions effectively. Capital budgeting requires us to apply these costs to specific metrics like net present value and the internal rate of return. While NPV provides an absolute dollar increase in shareholder value, IRR offers a percentage-based return that must be compared against the hurdle rate. We must also consider the payback period, which measures liquidity and risk by determining how long it takes to recover the initial investment. In our yield calculations, distinguishing between the bond equivalent yield, the money market yield, and the discount yield is a frequent area of confusion. These yield metrics are context-dependent, meaning they vary based on the calculation convention, such as a 360-day versus a 365-day year. Precision here dictates whether you are correctly comparing the yields of commercial paper against bank certificates of deposit. You should be able to shift between these day count conventions fluently to ensure your yield comparisons remain valid and meaningful. Foreign exchange mechanics often rely on the interest rate parity formula, which links spot rates, forward rates, and the interest rate differentials between two currencies. This formula helps determine the fair forward price of a currency, effectively preventing arbitrage opportunities in efficient markets. Transitioning to liquidity and working capital, we analyze the cash conversion cycle by decomposing the periods for inventory, receivables, and payables. Calculating the days sales outstanding, days inventory outstanding, and days payable outstanding provides a granular view of how cash moves through your operational plumbing. When reviewing bank account analysis, you will encounter the earnings credit rate, which banks use to offset fees based on your average or collected balances. This is a recurring theme in Treasury operations where optimizing the balance between fees paid and collected balances is a core fiduciary responsibility. Moving into risk and inventory management, we rely on derivatives valuation basics such as option delta, which measures the sensitivity of an option's price to the change in the underlying asset's price. Duration and convexity are essential when assessing the interest rate risk inherent in fixed income portfolios, providing a measure of price sensitivity to yield fluctuations. Value at risk, or VAR, offers a statistical estimate of potential losses within a portfolio over a specific time frame, assuming normal market conditions. For inventory, the economic order quantity model helps balance ordering costs against carrying costs to find the optimal reorder size. Finally, statistical measures like standard deviation, covariance, and correlation analysis are the bedrock of modern portfolio theory. These tools allow treasurers to quantify risk, diversify effectively, and model the impact of various financial variables on corporate performance. I look forward to discussing these metrics further in our next session. Welcome to the final review of our liquidity and working capital modules. This session synthesizes the interplay between operational cycles, cash management metrics, and the strategic deployment of short-term liquidity instruments to ensure financial health. Understanding the working capital cycle requires a firm grasp of the transformation of cash into inventory through the operating cycle and eventually back to cash via receivables collection. The cash conversion cycle serves as the primary metric for efficiency, measuring the time elapsed between the cash outlay for inventory and the cash inflow from sales. To shorten this cycle, practitioners often look toward inventory optimization techniques like just-in-time, which minimizes holding costs but introduces supply chain dependencies that require careful mitigation. By reducing the inventory conversion period, a firm frees up capital that would otherwise be stagnant, thereby improving its overall return on invested capital. This synchronization of internal processes with external credit terms creates a streamlined flow that defines an efficient treasury function. Receivables policy and payables management function as the two levers to balance liquidity against operational necessity. Credit standards must be set to balance the trade-off between increasing sales volume and the potential for increased bad debt expense or extended collection periods. If your collection strategy is too rigid, you risk damaging client relationships and losing market share to competitors with more flexible terms. Conversely, aggressive payables management through payment timing decisions can preserve cash, but it must be balanced against the risk of straining vendor relationships or losing early payment discounts. Strategic treasury management involves evaluating the opportunity cost of these discounts against the benefit of retaining cash for higher-yielding short-term investments or meeting operational contingencies. When we shift our focus to liquidity metrics, we rely on the current, quick, and cash ratios to provide snapshots of solvency and coverage. However, these metrics are only as useful as the underlying cash forecasting accuracy. which requires constant monitoring and variance analysis. When a forecast misses the mark, the Treasury must rely on internal liquidity sources or external facilities such as revolving credit lines or the issuance of commercial paper. The choice between these depends largely on the cost of capital and the prevailing yield curve, which dictates the attractiveness of short-term investment instruments. A normalized or inverted yield curve significantly changes the math regarding how long a firm should lock in liquidity. Therefore, investment criteria must always prioritize safety and liquidity before seeking incremental yield. Effective policy components must translate these high-level strategies into actionable implementation guidelines for the Treasury team. This includes setting clear constraints on the types of money market instruments allowed in the portfolio and defining the threshold for liquidity maintenance. When evaluating these instruments, the Treasury professional must consider the specific shape of the yield curve, as it provides a signaling mechanism for interest rate expectations and maturity preferences. An upward-sloping yield curve generally rewards the assumption of duration, whereas a flat or inverted curve suggests a preference for shorter maturities to maintain flexibility. By grounding these decisions in robust analytical frameworks and standardized investment policies, the Treasury organization mitigates risk while optimizing the utility of every dollar held on the balance sheet. See you in the next review session. Welcome back to our review session, where we will consolidate our understanding of corporate finance and risk management concepts. Today, we focus on synthesizing practical Treasury applications within the broader structural framework of risk and capital optimization. Enterprise risk management, or ERM, represents a holistic approach to understanding how various risks coalesce to impact the firm's strategic objectives. Unlike siloed risk management, ERM requires Treasury to integrate its activities with operations and corporate strategy to identify systematic vulnerabilities. When we look at capital structure optimization, we are essentially balancing the trade-off between the tax shield provided by debt and the inherent costs of financial distress. The weighted average cost of capital, or WACC, serves as the primary hurdle rate for investment appraisal. But one must remember that its utility depends entirely on the stability of the input assumptions. If the capital structure shifts significantly due to a new issuance, the WACC itself becomes a moving target, which can invalidate long-term project evaluations. This requires treasurers to maintain a dynamic view of the firm's cost of capital rather than relying on static historical figures. Managing debt covenants is an exercise in maintaining operational flexibility while adhering to contractual obligations with lenders. These covenants often act as early warning systems, but they can also restrict management's ability to pivot during market volatility. When choosing between issuing equity or debt, the Treasury professional must consider the signaling effect to the market and the impact on existing shareholders. Pricing mechanisms for these instruments are not mere mathematical outcomes. They are reflections of liquidity, credit risk, and macroeconomic expectations. Furthermore, identifying financial risk is only the first step, as quantification often presents the greatest challenge because of the opacity of market movements. Relying exclusively on historical volatility can lead to an underestimation of tail risk, which is why scenario modeling and sensitivity analysis are indispensable tools in a treasurer's kit. Foreign exchange exposure management requires a clear distinction between transaction, translation, and economic risks. Transaction risk is the most immediate concern for a treasurer, as it directly impacts the cash flows of pending contractual obligations. Translation risk, while largely an accounting concern, can influence reporting metrics and, by extension, stakeholders' perceptions of firm health. Economic risk, however, is the most profound, as it describes the long-term impact of exchange rate fluctuations on the competitive position of the business. Mitigating interest rate risk often involves a tactical mix of fixed and floating rate debt, supplemented by derivatives where appropriate. Swaps, caps, and floors are not just speculative instruments. They are surgical tools meant to convert the firm's actual interest rate exposure into a profile that aligns with the organization's risk tolerance. Operational risk controls are the silent pillars that prevent systemic failure, ranging from simple segregation of duties to complex business continuity planning. Insurance acts as a formal transfer of risk, yet it is often the last line of defense after internal controls have been optimized. The capital budgeting process remains the crucible where corporate finance meets operational execution, requiring rigorous project evaluation technique. Utilizing real options in capital investment allows for strategic flexibility, acknowledging that the value of an investment is not just in its base case cash flows, but in the future options it creates. This implies that Treasury must work closely with operational leads to ensure that the risk assumptions embedded in project evaluations are current and robust. Governance, standards, and ethics provide the necessary oversight that guides these complex financial decisions, ensuring that the pursuit of capital efficiency never comes at the expense of long-term organizational integrity. See you in the next lecture. Welcome. Let us review the core components of operations and technology that define the modern Treasury function. In this session, we will synthesize our understanding of payment systems, Treasury technology architectures, and the administrative controls necessary to govern these complex environments. We must start by revisiting the fundamental life cycle of standard payments, specifically the distinction between clearing and settlement mechanisms. Fedwire operates as a real-time gross settlement system, fundamentally different from the net settlement approach utilized by CHIPS or the batch processing workflows inherent to the ACH network managed by NACHA. When we move into the international sphere, understanding the role of SWIFT as a messaging standard rather than a funds transfer system is crucial for clarifying how cross-border liquidity flows. Furthermore, the card payment ecosystem introduces layers of complexity through interchange fees, where the merchant discount rate is influenced by card brand rules and issuer specifications. Mastery of these systems requires an appreciation for how data travels alongside value, ensuring that reconciliation remains accurate across disparate banking platforms. By organizing these concepts, you develop the ability to troubleshoot settlement failures and optimize payment channel selection based on speed, cost, and finality requirements. The shift toward modern Treasury technology architectures necessitates a clear distinction between the roles of a Treasury management system and an enterprise resource planning platform. While an ERP serves as the primary system of record for accounting and procurement, a dedicated TMS provides the specialized analytical engine required for cash positioning, forecasting, and debt management. The integration between these two systems, often facilitated via API banking or secure file transfer protocols, represents the most significant point of failure or efficiency in a Treasury department. As we rationalize global bank relationships, we must integrate these technical connections with the overarching governance structures that dictate how Treasury services are selected. This involves a rigorous request for proposal process where the primary objective is to align bank capabilities with the Treasury's internal requirements for liquidity management and risk reporting. We should view service selection not as a transactional event, but as a strategic alignment of the bank's technological roadmap with the organization's long-term financial architecture. Internal controls and cybersecurity represent the non-negotiable operational layer that protects corporate liquidity from external threats and internal errors. A robust control framework should rely on automated tools such as positive pay for check disbursements and ACH filtering to prevent unauthorized debits from hitting our corporate accounts. These tools are insufficient on their own. They must be embedded within a culture of rigorous account analysis and statement review procedures. Monitoring bank fee structures and understanding the impact of earnings credit rates on account analysis is not merely a cost-saving exercise, but a systematic check on whether our banking partners are fulfilling their service level agreements. Beyond technical safeguards, the regulatory environment, comprised of Basel III, Sarbanes-Oxley, and Dodd-Frank compliance, demands that Treasury departments maintain clear audit trails for every transaction. This extends to KYC, AML, and OFAC monitoring, where strict adherence to filing requirements like the FBAR prevents significant legal and reputational exposure. Effective bank relationship management is defined by the ability to quantify service value through methodical scorecarding rather than subjective assessment. When we evaluate our banking partners, we should maintain a clear performance ledger that tracks uptime, reporting accuracy, and response times to technical inquiries. This performance data serves as the foundation for fee negotiations, allowing the Treasury team to present evidence-based arguments for adjustments to account structures or pricing models. The movement towards centralized Treasury models often increases the efficiency of these banking relationships by standardizing mandates across various legal entities and geographies. However, centralization also places a heavier burden on the internal control framework to prevent systemic failure points that could interrupt global operations. Rationalizing these relationships by consolidating account services into a focused group of preferred partners reduces administrative overhead and minimizes the attack surface for potential cyber incidents. We must reconcile these competing interests, global reach versus operational control, through a disciplined approach to technology implementation and regulatory compliance. I will see you in the next lecture. Welcome back to our final review sessions, where we isolate the concepts that will define your success on the certification exam. We are starting our deep dive into the high-weighting topics that appear most frequently across all Treasury domains. When we analyze the weighting of the Treasury management exam, we must first address the integration of liquidity management with capital structure decisions. Many candidates fall into the trap of viewing these as siloed functions, but in the real world, they are deeply intertwined through the cash conversion cycle. If your liquidity position is thin, your cost of capital inevitably rises because the market perceives a higher risk of default or operational disruption. Think of your liquidity as the friction coefficient in the physics of corporate finance. Too little liquidity creates heat and resistance, while excessive liquidity represents a suboptimal allocation of capital that could be generating a higher return elsewhere. We must master the interpretation of financial statements through a Treasury lens, looking specifically at how operating cash flows impact debt service ratios. It is not enough to simply calculate a current ratio. You must understand how seasonal fluctuations in working capital necessitate different levels of short-term borrowing facilities. By focusing on how liquidity management directly influences the balance sheet, you provide the C-suite with the necessary buffer to navigate volatile market conditions without requiring emergency capital injections. Regulatory shifts also represent a consistent high-weighting area that requires a strategic approach rather than rote memorization. We need to evaluate how central bank policies and international standards like Basel III impact your organization's access to bank credit and the pricing of trade finance tools. When a regulatory change occurs, it rarely impacts just one silo. It ripples through your treasury technology stack, your tax planning, and your banking relationships. Consider the impact of transfer pricing regulations under the arm's length principle, which is a frequent area of interrogation for complex scenarios. If your intercompany funding structure does not reflect market-based interest rates, you face significant tax reclassification risks that could impair your cash flow projections. A professional treasury manager must anticipate these regulatory adjustments by embedding flexibility into their treasury management systems and legal entities. We will examine how to model these impacts by ensuring that your data inputs are granular enough to withstand an audit. Always ensure your strategic planning assumes that the regulatory environment is a variable, not a constant, in your long-term success. Financial risk management, specifically hedging, constitutes a critical domain that tests your ability to choose the correct instrument for specific market exposures. We encounter complex scenarios involving interest rate swaps and cross-currency basis swaps, which are designed to manage the cost of debt under varying macroeconomic conditions. You must develop an intuitive understanding of the mechanics. Why pay a premium for a cap when a collar might suffice, or why choose a cross-currency swap over a simple forward contract for long-term exposures? The key is to map the hedge precisely to the cash flow risk, ensuring that the accounting treatment, whether hedge accounting or fair value, aligns with the company's reporting requirements. If you miscalculate the delta or the basis risk in a complex hedge, you are simply trading one form of operational risk for a greater financial risk based on derivatives. We will focus our attention on the interaction between currency risks and the overall cost of capital, as this is where the most challenging analytical questions are situated. Maintaining a disciplined hedge ratio requires you to stay grounded in the fundamental purpose of the hedge rather than speculating on market movements. Technological integration has moved from a back-office support function to a core treasury competency that carries significant weight in modern exam questions. As we move towards more automated payment processes and real-time treasury management setups, the exam expects you to understand the security, control, and efficiency trade-offs. It is not just about choosing the right software. It is about the governance framework that surrounds that technology to prevent fraud and maintain data integrity. We need to look at how APIs and improved connectivity affect bank account analysis, as the traditional statement-based analysis is rapidly evolving toward real-time reconciliation. If your technology strategy is disconnected from your liquidity management strategy, you will inevitably end up with manual workarounds that introduce human error and risk. We will explore how to identify the bottlenecks in your current tech stack that hinder accurate cash forecasting. The goal is to build a system that produces reliable information, which serves as the bedrock for every other strategic decision we discuss in this course. See you in the next lecture. Welcome back. In this session, we will shift our focus towards synthesizing the theoretical knowledge we have cultivated into the practical application required for complex treasury decision-making. When approaching a professional certification exam, the ability to apply heuristics to unstructured business problems is just as critical as memorizing financial formulas. You are no longer dealing with isolated concepts, but with scenarios where treasury objectives often conflict, such as the inherent tension between achieving maximum liquidity and pursuing optimal yield. Consider a scenario where a multinational corporation must decide on a funding strategy for a new international subsidiary while simultaneously hedging foreign exchange risk. In such cases, one must weigh the cost of capital against the risk of exposure, often finding that the most mathematically sound option is restricted by local regulatory constraints or banking availability indices. By practicing this type of multivariable analysis, you prepare your mind to deconstruct complex stems into actionable data points, prioritizing variables based on their impact on corporate solvency and cash flow efficiency. This is the art of strategic treasury, where intuition informed by the body of knowledge allows for a systematic reduction of uncertainty. To master these scenarios, we must adopt a structured approach to elimination techniques that allows us to filter out distractors embedded in lengthy exam questions. These distractors frequently include irrelevant historical data or overly detailed company background information designed to obscure the core mathematical or ethical issue at hand. When deconstructing the question stem, focus first on identifying the specific treasury goal. Is the prompt asking for a liquidity optimization strategy, or is it testing your adherence to institutional professional standards? Furthermore, interpreting graphs and charts requires you to look beyond the visual trend and identify the underlying parameters defined in the prompt text. Often, the error occurs because an examinee applies a general rule to an exception cases, such as during a working capital turnaround strategy where standard operating metrics might temporarily shift to favor immediate cash preservation over long-term profitability. You should train yourself to read the question first, then analyze the data provided, and finally evaluate the options to find the most defensive and compliant answer. Time management during these multiple choice sequences is an exercise in resource allocation, much like managing a company's internal cash pool. You have a finite amount of time per question, and spending excessive energy on a single complex scenario can deplete your capacity to answer easier, high-weighting questions later in the exam. Efficient test takers quickly categorize questions based on their complexity and the time required for calculation, deciding whether to solve them immediately or flag them for later review. If a quantitative problem appears daunting, check if the provided answers are dispersed widely enough that a rough estimation can identify the correct choice without a full, detailed calculation. Always remember that the AFP body of knowledge values safety and risk mitigation. So look for the answer that suggests conservative practices within the scope of corporate governance and internal control frameworks. This mindset will serve you well, not only during the exam, but in your day-to-day role as you balance conflicting objectives to meet overarching corporate goals. See you in the next lecture. Welcome back to our final module, where we prioritize the psychological and tactical preparation needed to succeed on the CTP exam. We will examine how to manage test anxiety, optimize your physical endurance, and refine your approach to the question answering process. Successfully passing the CTP exam requires more than just technical knowledge. It demands the mental fortitude to sustain focus for a 3-hour session. Anxiety often stems from a lack of familiarity, so understanding the exam environment, including the provided software and the on-screen calculator, is your first line of defense. Arrive at the testing center aware of the specific identification documentation requirements, as any friction during the check-in process can unnecessarily spike your stress levels before you even read the first question. During the exam, maintain your endurance by utilizing your permitted breaks effectively, ensuring you remain hydrated and mentally refreshed. By treating the physical and psychological aspects of the test as a component of your preparation just as significant as your study notes, you stabilize your performance under pressure. Your tactical approach to the exam interface should emphasize efficiency through initial scanning and diligent flagging. Do not feel compelled to solve every question in the exact order presented, particularly if you encounter a technically complex calculation that threatens to derail your time management. Instead, perform an initial scan to identify questions you can answer immediately, which builds initial momentum and confidence. When you encounter difficult items, use the flagging feature to move on, allowing your subconscious to work on the problem while you secure points on more straightforward inquiries. This method of nonlinear navigation prevents you from becoming mired in a single difficult question, which is a common psychological trap that causes candidates to lose track of time. The process of elimination remains your most effective tool for navigating tricky multiple-choice queries, especially when absolute certainty is elusive. Begin by removing clearly incorrect options, which immediately narrows your field of probability and helps mitigate the influence of cognitive biases. When you must guess, use an informed approach by identifying distractors that contain extreme language, such as absolute terms like never or always, which are rarely correct in the nuanced context of Treasury operations. Furthermore, sharpen your reading comprehension by carefully highlighting words like not or except, as double negatives are frequently employed to test your precision rather than just your memory. By systematically quantifying the likelihood of each remaining answer, you replace random guessing with calculated decision-making. During your final week of study, shift your focus from passive review to targeted maintenance of your weak areas and physical wellness. It is easy to fall into the trap of overstudying familiar concepts while neglecting the topics that make you uncomfortable. But this is an inefficient use of your final hours. Maintain a schedule that prioritizes these weaker domains while ensuring you respect your biological needs for consistent sleep and nutrition, as the CTP exam is a rigorous cognitive marathon. Keep your study environment structured to mimic the silence and constraints of the testing center, which aids in reducing the novelty of the exam day itself. Documentation and logistics should be finalized several days in advance, removing any reliance on last-minute preparation that distracts from your final mental review. After the exam concludes, prepare yourself for a period of waiting where you should pivot your mindset away from the testing experience. Score verification typically takes a few weeks, and it is counterproductive to spend this time ruminating on specific questions you might have answered incorrectly. Once you achieve your certification, recognize that the process does not end with the score report. You must immediately transition into your initial continuing professional education plan to maintain your standing. The certification is an ongoing commitment to the discipline, ensuring that you remain abreast of evolving regulatory and technological standards in Treasury management. Focus on your immediate professional environment and how the knowledge you have demonstrated will now act as a foundational element of your daily work. Trust that these strategies will serve you well when you sit for your exam. Good luck with your final preparations. Welcome back, and congratulations on arriving at this final stage of our collective journey through the Treasury professional landscape. We have navigated the complexities of financial operations, risk frameworks, and strategic decision-making together. Reflecting on the breadth of material we have covered, it is essential to synthesize these learning objectives into a cohesive mental model. You have moved from understanding the granular mechanics of payment systems and cash positioning to the broader, more abstract concepts of capital structure and organizational governance. The goal of this synthesis is not merely rote memorization, but the development of a functional framework that enables you to navigate the Treasury environment with professional intuition. When you encounter a liquidity crisis or a complex funding requirement in your actual role, you should now be able to map that scenario back to the specific principles of effective Treasury management. This ability to connect theory to practice is what distinguishes a certified professional from an administrative operator. Think of this synthesis as building a decision-making engine rather than just accumulating a collection of facts. Your proficiency now rests on understanding the interplay between cash management optimization and the overarching enterprise risk management objectives of the corporation. As you transition into your final phase of preparation, performing a rigorous knowledge gap self-assessment is the next logical step. You should review the key summaries provided throughout this curriculum with a critical eye, identifying those areas where your confidence remains lower than you would prefer. If certain aspects of derivative hedging or the intricacies of international treasury still feel opaque, these are the focal points for your final study hours. I encourage you to leverage peer discussion platforms or professional treasury associations to test your understanding against current industry debates. Engaging with others in the field helps expose your logic to different perspectives, often highlighting nuances that are invisible when studying in isolation. This collaborative approach transitions your learning from a static textbook experience to a more dynamic, real-world application. Remember that identifying what you do not know is just as valuable as reinforcing what you have already mastered. Looking ahead, the commitment to Treasury excellence requires a mindset of continuous learning that extends far beyond the attainment of this certification. The financial landscape is perpetual in its state of flux, shaped by technological advancements in payment systems and shifting regulatory environments. You must remain current by consistently engaging with AFP publications, attending industry research webinars, and actively participating in the global Treasury community. Mentorship opportunities serve as an invaluable catalyst for career growth, providing context that can only be earned through experience and repeated exposure to complex market conditions. Consider mapping your career path to reflect the advanced responsibilities that come with the Certified Treasury Professional designation, positioning yourself for roles that demand higher strategic oversight. Leveraging this credential effectively means using it as a foundation for ongoing professional development rather than treating it as a terminal milestone. You are now part of a community that prides itself on precision, ethical standard setting, and effective resource management. As you prepare for the exam day itself, focus your energy on maintaining a composed and analytical mindset. You have diligently reviewed the mechanisms of corporate finance, scrutinized the intricacies of banking relationships, and parsed the details of risk mitigation strategies. The exam is designed to test your ability to apply these frameworks under pressure, so consistency in your study routine is your greatest ally. Approach each scenario as a professional task with solving a tangible problem for your organization, keeping the primary objectives of liquidity and solvency in mind. I trust that the preparation we have undertaken provides you with the structural knowledge required to navigate the assessment confidently. Trust in the work you have put forth, and maintain your focus on the technical requirements of the questions presented. The transition to the professional status you seek is near, and you are well equipped to make that leap. I wish you success in your final preparations. See you in the next part of your journey. Welcome to the final stage of our journey, where we synthesize everything we have covered into a cohesive framework. We will now summarize our core Treasury insights and outline the practical steps required to navigate the certification process successfully. Throughout this curriculum, we have dissected the role of the Treasury professional from every conceivable angle. We started by grounding ourselves in the Treasury environment, understanding that Treasury is not merely a back-office function, but a strategic partner that drives organizational success through value-added activities. We examined the intricacies of global regulations, payment systems, and the evolving landscape of card payments and financial technology. By maintaining a firm grasp on the regulatory environment and the technological infrastructure that supports liquidity, Treasury professionals ensure that the firm remains resilient. The shift toward digital efficiency and automated cash management is no longer optional. It is a fundamental requirement for modern operations. We have explored risk management through the lens of capital markets, foreign exchange strategies, and interest rate hedging, ensuring that you can now identify and mitigate exposures before they compromise the corporate balance sheet. As we look toward the future, it is clear that Treasury will continue to be defined by advancements in fintech and the relentless pace of regulatory evolution. You are now equipped with the theoretical foundations of working capital management, from receivables and payables optimization to advanced cash forecasting techniques. Integrating these components requires a high level of operational discipline and a commitment to rigorous internal controls. We have looked at how debt issuance, equity financing, and investment portfolio management align with the broader strategic goals of the organization. Your ability to apply these concepts in professional practice depends on your commitment to the ethical standards we discussed in our governance modules. The Treasury landscape is dynamic, and your success will hinge on your ability to synthesize these technical domains to solve complex business problems. Now that we are at the end of the instructional material, your focus must shift from learning to preparation and validation. We have reviewed the formulas, the risk frameworks, and the operational workflows, but the exam requires practical application under timed conditions. I suggest starting your final preparation by revisiting the checklist of key topics we addressed, focusing your energy on those areas where you felt less confident during the mid-course reviews. Ensure you are familiar with the registration process for the exam and begin engaging with professional communities to exchange knowledge and clarify any remaining ambiguities. This certification is a significant milestone, and your success is a testament to the effort you have put into mastering these complex subjects. Applying this knowledge effectively in your daily work will be your greatest asset, proving your value to your organization as much as the credential will prove it to the industry. Commitment to continuous professional development remains the hallmark of a true Treasury expert, even after you pass the exam. Stay vigilant regarding shifts in international compliance standards and emerging financial technologies, as these will inevitably reshape your workflows in the coming years. Your role requires a balance of technical precision and strategic vision, and I have every confidence that you are prepared to demonstrate that proficiency. As you move forward, keep a clear focus on the ethical implications of your financial decisions, as these are the bedrock of our profession. Remember that the knowledge you have acquired is cumulative. Every nuance of risk management or banking relationship analysis contributes to a larger picture of institutional stability. You possess the tools to navigate the complexities of global treasury, and I encourage you to leverage those tools with confidence. I wish you the very best of luck in your upcoming exam and your future endeavors.